Hello and welcome to session 22 of the Basic Tax course. We're going to begin session 22 with a review of the session 2021 homework answer key. And of course, the session 2021 homework assignment was a wowzer, a very complex assignment involving preparation of a complex Schedule C and accompanying schedules for a self-employed business owned by Jean-Luc Picard. We asked you to prepare a variety of forms, including a Schedule C for the profit and loss on his business. And given all the information that we provided you, that is the first form we will take a look at. But I did want to point out some specific details that are really relevant to this assignment. And one of them is the fact that Jean-Luc purchased a going concern business. And because he purchased a going concern business, he's going to need to report the sale of that business on a form called 8594. Which is an asset acquisition statement. So we will be showing you that completed form as a part of this answer key. In addition, he also qualifies for the domestic production activities deduction, so we are filling out that form. Now, in purchasing his business, Jean-Luc purchased a going concern operation, and that going concern came with a variety of assets, one of which is inventory. And inventory is important because that will be a cost of purchase for inventory for the year, which is entered on Schedule C in the cost of goods sold section of Schedule C. We also have assets that he purchased as a part of the business or during the year, and they include equipment, furniture, computer system. And each of these assets needs to be listed on the asset acquisition statement, and again, they need to be listed on a depreciation schedule. There's a computer system costing $200,000, furniture costing $50,000, and equipment at $300,000. Then there is something called goodwill, and goodwill is a Section 197 intangible. It is an asset that needs to be disclosed on the asset acquisition statement. But when we move over to the Form 4562, where depreciation is claimed, goodwill is an amortizable item that is claimed in Part 6 of the form at the very bottom of page 2, as is the covenant not to compete. And then, of course, this little chart here shows that the total purchase price of the business is $1.1 million. In addition to the acquisition cost of the business, Jean-Luc had or incurred costs associated with acquiring the business. And these costs included an SBA loan origination fee, which is assessed on a 10-year loan at $15,000. And that SBA loan origination fee is amortizable over 10 years. There's also an SBA business appraisal fee, and this is allocated to startup costs. So his total acquisition cost of the business is $1,125,000. Now, in addition to the startup costs shown here, Jean-Luc also incurred travel expenses as he was traveling around making a decision what business to purchase. And those travel expenses, when we get to them, will also be another kind of startup or another amount that adds to startup. We provided you information in the wording of the problem about 2 vehicles that Jean-Luc used in his business. Both of those vehicles need to be accounted for on the Form 4562, so we will complete that, along with all of the information relating to the number of miles driven, the number that were personal, the number that were commute. We've provided you with a variety of expenses that Jean-Luc paid in the operation of his business, and we've also provided you with a P&L for his business, listing out a number of expenses that he paid for the year. And your job, of course, was to go through, interpret each and every expense, and put them on the correct line of his Schedule C and the various other forms. So let's get on with that. So as an overview of the answer key on this problem, let's begin at the top on page 1 of the answer key, where it states that the cost of purchasing enterprise must be broken down into component parts before Jean-Luc's tax return can be completed. The component parts are as follows. Firstly, we have startup costs. They totaled $25,000. $10,000 was for the SBA appraisal fee, and $15,000 was the research and travel expenses that Jean-Luc incurred over the 2-year period 2010-2011 as he was coming to a decision to buy the business. Now, under IRS rules, it is permissible to claim up to $5,000 of startup expense as a deduction in the year that business operations begin. Jean-Luc will take advantage of that particular rule, and he will then amortize the remaining $20,000 of startup costs over 15 years. And the software that we use, Drake Software, has really allocated all 25,000 of startup over to Form 4562 and has increased the amount of amortization deduction allowed by $5,000. It could be that your software, or if you were preparing this problem by hand, that you just hand wrote or directly entered on the other expense line of Schedule C startup costs as a deduction. And that's probably quite acceptable as well if your computer or you just by $5,000. It could be by hand that you, or if you were preparing this problem, or directly entered on the other expense line of Schedule C startup costs as a deduction. Acceptable as well if you, and that's probably quite acceptable. Your computer or you just by $5,000, just hand wrote $1,000. It could. I just wanted you to understand that our computer software put it all on the 4562, and when we get to it, you'll see what I mean. Now, other assets that need to be amortized or depreciated on Form 4562 include $300,000 for the equipment, and under ADS, we have a 10-year recovery period for the cost of that equipment. $50,000 for the furniture, also being depreciated ADS. That's a 10-year recovery period. Then there's $200,000 for the computer system with a 5-year period using Maker's double declining balance. There is $150,000 of goodwill. That is 15-year amortization. There is $100,000 for a covenant not to compete, which is also 15-year amortization, and then $15,000 for a loan origination fee, which is 10-year amortization. Finally, $300,000 of inventory purchased, which is treated as a part of the cost of goods sold on Schedule C. Prior to completing Form 4562, which is where we're going to enter all of these items, a depreciation schedule should be prepared, and we have prepared a depreciation schedule. And you can see on our depreciation schedule that we've listed each asset. The date placed in service is the date Jean-Luc purchased and opened the doors for business on his new enterprise business. And there's one other item in here, which is the GMC Yukon. You will see that it does not have a 6/30/2011 date placed in service because he purchased that vehicle well after he opened for business. And then under the cost column, we list the cost of all of the assets sold, including the startup costs in full. And we total up all of our assets placed in service for the year. They come to $892,000. Business use percentage on all assets is 100% except for the GMC Yukon, which does come out at a lesser amount. We figured that based on the mileage amounts that Jean-Luc reported, and we will show you how we calculate that in just a little bit. But carrying across on the GMC, you will see that under the IRS rules, because this is an SUV that weighs over 6,000 pounds, he is allowed to claim a Section 179 deduction, but he is not allowed to claim more than $25,000. So we enter $25,000 in the column for Section 179 deduction. And in addition to the $25,000 deduction, he can claim depreciation on his remaining basis in the vehicle. And the remaining basis in the vehicle, business-wise, after he claims the Section 179 deduction, is $5,103. So $5,103 times 20% is $1,021, but you will see this current depreciation shows $2,621, and that's because if you take a $25,000 and add $1,021, you will get $26,021. For the startup costs, you will see that the startup costs were $25,000, and they're being amortized over 15 years. The rate of amortization in that first year is 3.8889%. And to get that, you essentially divide $25,000 by 15 years. You then divide the result by 12 months, and then you multiply out by the number of months in service for the year. We get all of the months of June plus the remaining 6 months of the year. So that factor, or that number that we multiply by, is 7. So we essentially go 25,000 divided by 15 divided by 12 multiplied by 7. And we get $778. When we take $778, we add to that $5,000 for the initial first-year deduction under startup costs, and we get $5,778. We total up all of the current year depreciation deductions, and we get $99,896. So looking here again at the depreciation schedule, I did want to point out life and method. Jean-Luc is claiming ADS 10-year depreciation on the equipment and the furniture, which is why we see 10-year life. He is claiming 5-year double declining balance or 200% declining balance on the computer system. The amortizable life of the goodwill is 15 years. The amortizable life of a covenant not to compete is 15 years. The loan amortization life is 10 years. The 5-year depreciable life on the GMC Yukon and 15-year amortizable life on the startup costs. Under method, Jean-Luc is straight line half-year convention for the equipment and the furniture. And that gives us a rate for 2011 of 5% and a current deduction of $15,000 for the equipment, and a rate of 5% and a current year deduction for the furniture of $2,500. Under the computer system, he is claiming 200% declining balance. That gives us a 20% first year rate, and we multiply 20% by 200,000. That gives us $40,000. Under the goodwill and the covenant not to compete, we do need to enter on the Form 4562 in the amortization section in Part 6, the amortization code that applies. And both the covenant not to compete and the goodwill are Section 197 intangibles, and that's the section code we're referencing here. Then the points are amortizable under Section Code 461. We've identified that here. And the startup costs are amortizable under Section Code 195. Part 5 of Form 4562 needs to be completed with relation to the vehicles that Jean-Luc used in his business. The first vehicle we'll take a look at is the GMC Yukon. It is listed property used more than 50% in the business activity. We need to describe the Yukon in Part 5 of the form. It will be listed as listed property used more than 50%. And in fact, it was used 58%. How do we get 58%? We'll take the 5,700 business miles and divide that by the total miles, which were 9,846 miles. We will enter on Form 4562 the acquisition cost of the Yukon, which is $52,000, but we will need to multiply that out by the business use percentage and also compute the $25,000 Section 179 deduction on the form. The Dodge Caravan is the second vehicle Jean-Luc used in his business, and it was used 50% or less in the business activity, so it is entered on a different line in Part 5 of the form. And the mileage information for the Dodge Caravan is shown here. We have 7,000 business miles, 2,000 commute miles, and 11,000 of all other miles. So the total miles put in that vehicle were 20,000, of which 7,000 are business miles. In Form 4562, Part 1, we need to enter the assets for which a Section 179 deduction might be claimed. And the assets for which a Section 179 deduction are possible are the equipment, the furniture, the computer system, and the Yukon. And the Yukon is multiplied out by its business use percentage. 52,000 times 57.89% is $30,102.80. We add that to the cost of the other assets purchased. So the total Section 179 assets placed in service for the year are $580,102.80. On the Form 4562, we have a baseline amount of $2 million. We also have another baseline amount of $500,000. And because Jean-Luc's assets placed in service fall below $2 million, he is not going to be subject to a phase-out based on the cost of assets placed in service during the year. But above and beyond that, the only asset he is claiming a Section 179 deduction on is the Yukon. And so we've entered $25,000 of allowable Section 179 deduction for that vehicle. Regarding the amortization amounts, I did want to show you just a federal supporting statement that we created for those deductions. And Form 4562 on line 42, we've attached this statement. And on line 42 of Form 4562, we've said see Statement 1, and this is Statement 1 right here. We have the cost or description of the asset for which amortization is being claimed, the date the asset was placed in service, the amortizable amount, and the code section under which it is being amortized, and finally the amortization deduction being claimed. The total amortization deduction for assets being claimed is $16,375. Moving on to some information regarding the Schedule C and cost of goods sold. Remember that cost of goods sold does need to be tracked and reported correctly on Schedule C. And we have $300,000 of inventory that was purchased with the business. So that is the amount that we've entered on line 35 of the Schedule C. We also have cost of labor totaling $100,000 and cost of materials at $400,000. and the cost of shipping materials in, as shown on the P&L, is $50,000. We add those numbers up and we get $850,000, and then in the problem we told you that the closing inventory was $350,000. So we subtract $350 from $850, and that gives us an inventory expense, or a cost of goods sold expense, of $500, which is entered on Schedule C, line 4. And here is Enterprise's P&L, and you can see the P&L shows cost of goods sold at $550,000, but does not account for the opening and closing inventory adjustments. So the amount that's shown here for cost of goods sold is not really a reflection of the true cost of goods sold that's reported on the tax return. But the information provided here is used by you, the tax preparer, to figure the cost of goods sold entries for the Schedule C. Then we have all of the other expenses of the business, and significant among these expenses is that $1,000 of health insurance for Jean-Luc. But also we need to be aware of some other entries that may not be shown on here, including, for example, amortization expense and depreciation expense. Those amounts are not reflected on this P&L. So even though we have a profit and loss here for the business, the tax return is going to look somewhat different when it's finished. For the most part, most of the expenses you see here carry directly over. Health insurance of $10,000, of course, must be reduced by $1,000, since $1,000 is for Jean-Luc. Only $9,000 is reportable as an expense deduction on the Schedule C. Meals and entertainment have to be reduced. You can only claim 50% of those costs. So most entries in Part 2 of Schedule C are directly recorded from Enterprise's P&L. However, amounts reported on Line 9, which are the car and truck expenses, Line 13, depreciation and Section 179 expense, Line 14, employee benefit programs, and Line 24B, meals and entertainment, are adjusted, and calculations have to be made to determine the amount to enter on those lines. Here is an auto expense worksheet for the Dodge Caravan. Most tax software programs provide auto worksheets, and depending on the quality of the worksheet, you may find it's helpful to use it. You may find it's not helpful to use it at all. Many years ago when I first got into this business, I was using Lacert, and they had a terrific auto expense worksheet program. It did everything the way it should, and I used it a lot. And then we switched over to Drake and found that we had an auto worksheet program that was really quite dreadful. And I stopped using it. I started using other methods to basically determine my auto expenses. But about 4 years ago, 3 years ago, somewhere in there, Drake finally got it figured out, and now their auto expense worksheet is quite workable for us. And so we have chosen to start showing the Drake auto expense worksheets in our answer keys. Here we can see that we've identified the vehicle for which expenses are being reported and the date placed in service for the vehicle. Space is provided on this worksheet to show the total business miles driven during the year, the total commute miles, and the total of other miles that were driven during the year. And we end up with total miles of 20,000 that include other miles of 11,000, 2,000 of commute, and 7,000 of business. The business use percentage on the Dodge Caravan is 35%. We go down and we are going to claim standard mileage rate on the Dodge Caravan. We had 4,200 miles before June 30th. And that is multiplied by 51 cents per mile to give us a deduction of $2,142. Business miles after June 30th were 2,800, and we multiply those by 55.5 cents per mile, and that gives us $1,554. So the total mileage deduction for the Dodge Caravan is $36.96, and that carries over to line 9 of Schedule C and is entered as an auto expense. But we're not quite ready to put a total on line 9 of Schedule C yet because we have a second vehicle and we have to figure its expenses separately. And we begin with the mileage. The business miles are 5,700. Commute miles are 1,000. All other miles are 3,146. So total mileage is 9,846. 5,700 divided by 9,846 is 57.89% business use. And in this problem, we've identified a variety of expenses that are being listed because Jean-Luc has decided that he's going to claim actual expenses on the Yukon, including that Section 179 expense deduction. So we begin with the amount of depreciation that he is claiming on the Yukon. And on the full purchase price, the depreciation deduction is $1,764 after taking out the Section 179 deduction, but we're only allowed 57.89% of $1,764, and that gives us $1,021. We then go down to the next line where it shows $1,000 was paid for gas, but again, we're only allowed 57.89% of the cost of that gas. That gives us $579. Then we have insurance costing $2,000. 57.89% of 2,000 is $1,158. Finally, we have new tires costing $600. 57.89% business use gives us $347 for tires. And the Yukon loan interest was $1,500. 57.89% of $1,500 is $868. So total expenses for the Yukon for the year are $28,973. Figuring the standard mileage rate gives us a lower number. And in the end, we're going to claim the $28,973 of expenses, of which $2,952 are entered as auto expenses, and the remaining amount is claimed as a depreciation deduction. Another form that we needed to prepare with Jean-Luc's tax return is Form 4797. The form is required because he sold an asset that he used in his business during the year. That asset was the Dodge Caravan. Now, according to the wording in the problem, we're telling you that he purchased that van back in 2007 for $30,000. However, at the time he placed it in service in his business, it had a fair market value of $8,500. So $8,500 is the cost basis that we will use for computing the amounts to enter on Form 4797. With an acquisition cost of $8,500, we now need to multiply that cost by 35% business use, and when we do that, we get $2,975. Next, we have to look at any reductions to basis through depreciation, and for 2011, 22 cents of each mile claimed under the standard mileage allowance is for depreciation. Jean-Luc had 7,000 business miles at 22 cents per mile. That gives him a $1,540 deduction for the year. So we have $1,540 of prior depreciation claimed. The acquisition cost for after applying the business use percentage is $2,975. That gives Jean-Luc an adjusted basis in his business use portion of the minivan of $1,435. We now look at the selling price of the van, and he sells the van for $8,000. So we look to 35% of $8,000. That gives us a $2,800 sales price. We have a net gain realized on the sale of the van, which is $1,365. It's calculated as follows. We take the $2,800 sales price, subtract out the adjusted basis of $1,435, and that gives us $1,365 of gain on the sale of the minivan, and that is reported on line 14 of Jean-Luc's Form 1040, as well as the appropriate lines of Form 4797. Jean-Luc, on his Form 1040, is allowed a variety of adjustment items. The first one is that he will be able to claim a deduction for part of his self-employment tax. He will also be able to claim a deduction for self-employed health insurance premiums that he paid, and he is allowed to claim a domestic production activities deduction. We will show you how to compute all of those. And here is Jean-Luc's 1040 form. We begin up at the top by entering a filing status of single. And on line 12, we've entered the profit from his business, but we do need to show you how we calculated that. So let's head to the Schedule C. And here we have Jean-Luc's Schedule C up on the screen. We can see that we've entered a business code from the instructions of 333000. The business activity is manufacturing. The business name is enterprise. We've entered the business address. Then for item F, we have checked the cash method of accounting. For item G, did Jean-Luc materially participate? He most certainly did, so we check the yes box. Item H, if you started or acquired the business during 2011, check here, so we have checked that box. Item I, did you make any payments in 2011 that would require you to file Form 1099 miscellaneous? And in the wording of the problem, we told you that advertising and rent expenses were paid to unincorporated businesses. Jean-Luc has issued Form 1099 miscellaneous where required. Gross receipts for the business, as shown on the P&L, were $1 million, and that is the amount we've entered on line 1B of his Schedule C. We also explained how we arrived at a cost of goods sold figure of $500,000, but let's go take a look at how we computed that on the form itself, because that is done on Part 3 of Form 4562. And on Part 3, we show the inventory at the beginning of the year. He purchased $300,000 of inventory when he bought the business. We've entered that as opening inventory. We add in the cost of labor that he had. We can see on the P&L that labor is $100,000. We also entered other costs, which was shipping in of $50,000. So we have $100,000 Plus, we have $300,000 of opening inventory. We then have materials and supplies. We tell you on the P&L that that was $400,000. And finally, the shipping and cost of $50,000. Those numbers add up to $850,000. And then in the wording of the problem, we tell you that his ending inventory on 12/31 of 11 was $350,000. That amount is entered on line 41. Line 41 subtracted from line 40 is $500,000. $500,000 carries to page 1 of the form and is entered on line 5. Line 5 subtracts from line 1D, and that leaves line 7 at $500,000. And now it's time to start moving over and entering expenses as they are shown on the P&L and in other reference documents that we provided to you. The first of which is advertising expense. $50,000 is shown on the P&L, and that is the amount that we entered. I've already described earlier in this video how we computed the car and truck expense deduction of $6,648. And the depreciation deduction, well, I do need to show you that, so we'll get to that in just a minute. The employee benefit program, that is the health insurance expense. $10,000 minus $1,000 of owner's insurance leaves a $9,000 deduction for that line. On line 16, we show other interest expense, and we can see down here that we had a SBA loan interest expense of $50,000, and that is what we entered on line 16B. Then on line 20, we entered the rent on line 20B. That was $50,000. Taxes and licenses totaled $31,000. You can see down here on the P&L we had payroll taxes totaling $30,000 and Milky Way business license of $1,000. That is where we get the total of $31,000. Travel, according to the P&L, was $5,000. And you can see that we have local entertainment expense plus travel meals at $1,000. But the 50% limit has to be applied. So of the $3,000 of total expense, we are entering $1,500 on line 24B. On line 25, we've described the utility expense of $10,000. That's directly from the profit and loss. And other employee wages and salaries were $100,000 from the P&L. Other expenses are shown on the other expense line on page 2 of Schedule C. Those expenses include telephone costs of $5,000, shipping and delivery charges out, you can see those listed here at $50,000, and amortization at $16,375. Let's take a look at the 4562 next. And we'll begin at the top of page 4562 on page 1. You can see that we've entered the total cost of Section 179 property placed in service during the year. I already described how we got that figure, $580,103. Then on line 7, we're showing the amount of Section 179 deduction claimed on listed property. That comes from Part 5 of the form on page 2, and that's $25,000. On the depreciation line 19, we're showing the total cost of 5-year property placed in service during the year. That was $200,000 with a $40,000 depreciation deduction. And in Section C, we show that we have assets with a class life of 10 years costing $350,000, and that the straight line depreciation deduction over 10 years is $17,500. Moving over to page 2 of the form, we list 2 vehicles. The GMC Yukon is shown on line 26 because it is more than 50% business use, and the Dodge Caravan is listed on line 27 because it is less than, more than 50% business use. It is 35% business use. We can see that we have a cost or other basis of the Yukon at $52,000. Basis for depreciation after we claim a Section 179 deduction of $25,000 is $5,103. We show that the depreciation deduction is $1,021 and the elected Section 179 cost is $25,000. For the Dodge Caravan, we are claiming the standard mileage allowance, so we've left the basis information entries blank. But in Section B, we do provide the mileage information and check the boxes appropriately for the business use on that car. And down to Part 6 of Jean-Luc's Form 4562, we see that we've entered C Statement 1, and the amount of amortization deduction claimed is $16,375. We already showed you how we computed that deduction, but essentially it is all of his amortizable assets being amortized over their correct life, including the first year additional deduction for startup costs. Next up is Jean-Luc's Form 8903. His entire business activity is domestic, and so all income and all expenses of the activity are entered on Form 8903. You follow the form through and enter the appropriate amounts for wage income, for gross income, for profit and adjusted gross income as shown on his personal 1040 return. And when we're all said and done, Jean-Luc is eligible to claim a domestic production activities deduction in the amount of $2,706. And another form that Jean-Luc needs to attach to his return is, of course, the asset acquisition statement. He needs to identify the class of asset being placed in service for the year. The going concern value, or the startup goodwill, is a Class 6 and Class 7 asset, and we've listed those at $250,000. We have Class 4 asset, which is the inventory or goods in trade. That was $300,000. And then all other assets purchased as a part of this business are $550,000. The 8594 form needs to show that Jean-Luc is the name shown on the tax return and that the name of the other party in the transaction was Jordy LaForge, and Jordy's information is entered as seen here. And here is Jean-Luc's Form 4797. The asset sold was a Dodge Caravan. The Caravan was placed into service and taken out of service in the same year, and it was also held for 1 year or less. We therefore report the sale of the asset in Part 2 of Form 4797. We provide a description, we provide the gross sales price, we provide the amount of depreciation he claimed, and the net gain from the sale. This $1,365 gain carries to the 1040 and is entered right here on line 14. Returning to page 1 of Jean-Luc's Schedule C, we can see that all of his expenses have now been entered. I've explained where we've gotten them. He has a net profit from the business in the amount of $31,956, which is entered on line 12 of his Form 1040. On line 27, we show the deductible part of his self-employment tax, and we computed that on the Schedule SE. We begin with $31,956, multiply that by 92.35%, take the result of $29,511 and multiply that by 13.3%, and we get $3,925. This is the amount of self-employment tax to enter on line 56 of Jean-Luc's 1040, and 57.51% of his self-employment tax is $2,257, and we take that $2,257 and enter it here on line 27. Next, we have the self-employed health insurance deduction. Jean-Luc cannot deduct that on Schedule C, but it does meet the tests for claiming that deduction on line 29 of his 1040, and there we've entered it. Then on line 35, we enter the domestic production activities deduction as we showed you on Form 8903. That was $2,706. Jean-Luc's total adjustments to income are $5,963, and his adjusted gross income for the year is $27,358. He is claiming a standard deduction and a personal exemption. His taxable income is $17,858. That computes to $2,256 of income tax. We add in his self-employment tax, and that leaves him with a tax bill for the year of $6,181. So that concludes the review of Jean-Luc's tax return. It is now time for you to take the Session 2021 quiz. So please push pause on video playback and complete the Session 2021 quiz. When you are ready, please resume video playback for the Session 22 lecture. And with that, we're going to move on with the content of today's class. Now, today's class is, I've always thought we should call it something like the mishmash session or the kitchen sink session. When I teach tax law, I look at a tax form and I say, okay, we can talk about pensions and Social Security. That's a defined topic. It's easy to talk pensions and Social Security and put it all into one place. And after you've covered pensions and Social Security, you can, of course, go on and talk about wages. You can talk about interest. You can talk about credits. You can talk about itemized deductions. But there comes to be a point where there's a bunch of stuff out there that isn't worthy of a session all by itself, but it needs to be covered at some point. Well, that's today's class. So today we're going to talk about a lot of different things simply because there's a lot of little small topics that are really highly relevant to tax, none of which warrants an entire session on its own, but somehow I've tried to cram them all into today. And although the course is called Amended Returns and Kitty Tax, you'll find that those are actually a pretty minor topic in today's class. We've got so much that we're fitting in. Those were just kind of two items that I highlighted out. And we're going to move down to the introduction. And of course, today's topic, one of today's topics, is talking about other taxes. And most individuals pay only one kind of tax, at least to the federal government, and that's income tax. You fill out your tax return, and at the end, you've got this income tax you pay. But there's more than just income tax that actually is assessed on the 1040 form. And so in today's class, we're going to be talking for quite a bit about some of those other taxes. Now, as an orientation or as a beginning point, I wanted to point to line 44 on the back page of the 1040 form. Line 44 is where you go to compute your tax. And essentially what happens when you compute tax is you start with your adjusted gross income on line 38. You subtract out your standard deduction or your itemized deductions if you have any. You then subtract out your exemption deduction. That's you, your husband or wife, and your children if you have dependents. And you arrive at a number on line 43, which is called your taxable income. Now it's time to go to the tax tables and look up the tax you owe. And if the number on line 43 is higher than $100,000, you actually have to use tax rate worksheets to figure out the tax that you'll owe. Now, after you've done that, you might have other taxes that you need to pay. So the income tax that you calculate on line 44 is just the starting point. After you calculate the tax on line 44, you also have to consider whether or not you might be subject to alternative minimum tax. And if you're subject to alternative minimum tax, that tax is entered on line 45. And of course, you have to fill out a form called 6251 to recompute your alternative minimum taxable income and the alternative minimum tax owed on that income to see if the alternative minimum tax is higher than the regular tax. And if it is, you get to enter the difference on line 45. Okay, that's nice. Now we get to claim a few credits in here. Maybe that'll reduce our tax somewhat. And we come to a number on line 54, which is our total credits, and we subtract that from the total tax on line 46. And on line 45, we have our income tax. Sort of. But we're not done, because there's these other taxes that I've highlighted in pink, and we're going to spend some time talking about these today. Firstly, on line 56, there's self-employment tax. And we're not going to spend any time on self-employment tax today because we really cover that more in our session on self-employment, but it is one of the other taxes on the line. We also have line 57 where we talk about unreported Social Security and Medicare tax on tips, but also on wages that are not tips. And when it's not tips that you're talking about, you fill out 8919. If you are receiving tips and you did not report your tips to your employer and you're going to be paying the tip tax, then you would fill out Form 4137. And we're not going to talk about 4137 in today's class because we did that in an earlier session when we talked about wage tips and other investment income. But we will look at this other Form 8919 today. We'll spend a little bit of time talking about it. Next in line is line 58, and this is where we enter the early withdrawal penalty or the additional tax owed on early distributions from IRAs and other kinds of retirement accounts. And we're also not going to talk about that today because we did that in our class on pensions. Underneath that, we have the household employee tax that is entered on line 59A, and we will talk about that one. And underneath that, we have the recapture of the first-time homebuyer credit, and we will also be talking about that in today's class. Then on line 60, we have all other taxes. That's all the other taxes that are out there that don't have a line somewhere else. And interestingly, there's a lot of them. This is actually a new line this year. The IRS has never had this line here before. They've added it. In the past, you just entered your other taxes on the dotted line and totaled them. But now they've given you a dedicated line and a system that says enter the code from the instructions. So we'll take a look at that as well. Now, after we're all done with computing our taxes, we look at our federal withholdings. We look at some other refundable credits, such as the Earned Income Credit and the American Opportunity Credit. And when we get to the bottom on line 72, we have our total payments. We subtract total payments from the total tax shown on line 61. And we either have an overpayment or we have an underpayment. If we have an underpayment, and sometimes even when we have an overpayment, it may be that we've not paid tax correctly throughout the year, and because we have failed to pay in installments as we should, or we owe too much when we file, we might be subjected to another kind of tax, but this one is a penalty. And of course, we're going to spend some time today talking about the estimated tax penalty, who has to pay it, and who does not. So we already talked about line 44 at the opening paragraph there. And line 44, just for clarification, is where you compute your income tax based on your taxable income. And the taxable income comes from these tax rate schedules. And I pulled these out of Pub 17. Now, very often we have customers who will say to us, well, what tax bracket am I in? And the answer is, well, you have to figure their taxable income. Once you know their taxable income, you can peg them with a tax bracket. So if your filing status is single and the taxable income you computed for yourself on line 43 of the 1040 form is somewhere between $34,500 and $83,600, then you could say, oh, well, you're in the 25% bracket. And if the taxable income is, well, zero, you have no tax. You're in the 0% tax bracket, we would say. But if your taxable income is somewhere higher than zero and less than $8,500, then you would say you're in the 10% bracket. And of course, then if you're doing fairly well off, you've got one of those nice executive type jobs with big paychecks coming to you so that your income is over $379,150. That is your taxable income shown on line 43. Then you would say you're in the 35% bracket. So that's how those tables work, and it's just a common question I get. Now, of course, you can use the tables until the number on line 43 hits 100,000. If the number on line 43 of your 1040 goes over 100,000, you can't use tables and you have to use worksheets. Now, sometimes the tax that you compute using the tax rate charts or the tax rate schedules does not actually give you the correct tax. That happens when you have special kinds of tax computations that are going to affect the amount of income tax that you have to pay. And some of those special items include if you have income from qualified dividends or capital gains, because of course the maximum rate of tax on qualified dividends and capital gains for 2011 is 15%. So if you have that kind of income and you're in the 30% or the 35% bracket, clearly you're not going to get the right answer from the tax rate worksheets. And so you're going to have to do a different kind of worksheet instead, a capital gain worksheet, to figure out the amount of tax you owe on that. There's also the situation where if you have investment income over $1,900 with certain children, in a situation like that, you're also not going to get the correct tax either from the tables or from the worksheets. And we're going to talk about this tax towards the end of today's class. Then there is the parent's election to report the child's interest in dividends. And that, again, is going to mean that the amount pulled off the tables and the worksheets is incorrect, and we will talk about that at the end of today's class. And the last one I have here pegged is the foreign earned income exclusion. That is an exclusion you can claim if you worked overseas, either as a resident of a foreign country or as a U.S. national who is continuously outside of the United States for a period of at least a year. And if you qualify for that foreign earned income exclusion, you actually don't have to pay tax to the United States on your foreign earnings. But in certain situations, your foreign exclusion could be less than your foreign earnings, or it could be the case that your foreign earnings are not the only income that you had. And when that happens, you're going to have differences in how your tax rate is how your tax is figured on the remaining income that you have. So if my income from working overseas is $100,000, and on top of that $100,000 of income from working overseas, I have another $100,000 of income from ownership I have in a partnership, say. I'm not going to be able to use the tax rate worksheets to figure that out because the United States government is going to allow me to exclude my foreign income, but it's also going to say, hey, you're still going to be in the higher bracket associated with the higher income, and we're not going to allow you to scoot into a lower tax bracket on the remaining income. And so to do that computation, we have the foreign earned income tax worksheet. And you would need to fill this out just to figure the number that will go on line 44 of the 1040. And then underneath that, I have a copy of the qualified dividend and capital gain worksheet as well. There's a question from Elenita Yamabi. Do I have to file a foreign earned income tax return at the state level? Well, that would depend if you're still considered to be a resident of the state. So typically, if a person moves overseas, they're going to make their new home overseas, and they're going to give up residency in the state that they've been living in. But the rules for U.S. citizens and residents of the United States, green card holders, is that if you move overseas and you live overseas, you're still a U.S. citizen or still a U.S. green card holder. And the fact that you left the country doesn't change that. You're still subject to American tax law. The states are not as broad in their scope of definition of residency. So at the state level, you're a resident of the state if the state considers you to be a resident. And for most states, that is, you have a home there, you're registered to vote there, your family is there, your financial accounting is there. And if none of those apply to you because you're now overseas and you've cut all ties with your state, then you wouldn't need to file a return with the state at all. Unless, of course, you had investment, or well, investment income would be a bad example, but unless, of course, you had business income or you had a rental property, for example, in that state. Now, in a year where perhaps you work in a state and then you leave that state to move overseas, you might be considered a part-year resident of that state. Now, I do have a client who is a resident of Oregon who has accepted a 3-year assignment to Vietnam. He is maintaining his home in Oregon. He is returning frequently to Oregon. His family is still in Oregon. And so we've had a discussion about whether or not he wants to consider himself as a resident of Oregon or whether he really is now considering himself to be a resident of Vietnam. That one's a little bit tougher because of the ties he's maintaining here. So you really have to go to the state level and determine what the state is saying. Does the state consider you to be a resident or not? All right. Now, the alternative minimum tax, I touch on the alternative minimum tax frequently throughout our courses. Today, I'm just touching on it again. If you really want to know about AMT, I cover that in detail in our course called Understanding the Alternative Minimum Tax. But at the beginning of today's class, I explained that when you figure your tax for line 44, you also have to go over to Form 6252 and figure your tax under alternative minimum tax. Now, what would cause the alternative minimum tax to be higher than the regular tax? Well, there's a number of things, and it boils down to the fact that under the alternative minimum tax, you are not allowed to claim certain deductions that you are allowed to claim under the regular tax. Also, the alternative minimum tax has essentially only 2 tax brackets. I believe they're 26 and 28% or 28 and 30%. I think it's 28 and 30%. Those are the only 2 brackets. So if you're in the 10% bracket at the federal level and it's 28% under AMT, obviously AMT is going to kick in. Well, what causes that transition to occur, what would push you into there, we'll talk about that in detail in another class. But for today, what I will tell you is the types of deductions you might have claimed or the types of income categories you might have reported on your personal return that would get different treatment under the regular tax than they do under AMT. And if any of these apply to you and your income is high enough, that is when AMT kicks in. The first of these is almost impossible to believe, but did you know that under the regular income tax, you are allowed to claim a deduction for yourself, your spouse, and your dependents? Yeah, well, that's pretty obvious. We know that. But under AMT, those deductions are thrown out. Don't get them. So if you're a filer, maybe earning $100,000 a year, and you've got 7 kids at home, you could be paying AMT only because you have children, lots of them. And that has happened. I actually, when I first got into this industry, close to 20 years ago, I did a tax return every year for a man who was a fireman. And he earned pretty good money. In the days at that time, we're talking in the early 90s, he was
had a W-2 of around $70,000. And every year he paid AMT because he had so many kids. Next one in line is the standard deduction. Under the regular tax, you get a standard deduction, but under AMT, nope, thrown out, don't get it. Under AMT, you are allowed to itemize your deductions, and you are allowed to claim the deduction for most types of home mortgage interest. However, under AMT, you're allowed to claim fewer deductions. And among the deductions you are not allowed to claim under AMT are state and local income taxes, home equity loan interest is not allowed, and most miscellaneous deductions, that is employee business expense type deductions. And under the regular tax, your limit on medical is 7.5% of your adjusted gross income. Under AMT, it's 10%. Also, the AMT, since it does not give you a deduction for state income taxes, won't tax a state refund if you had it, so it will subtract that refund from your income. There are differences between how alternative minimum tax allows you to depreciate property, and if you claim accelerated depreciation on your tax return, AMT may kick in and take away that extra deduction for accelerated depreciation. Also, there can be differences between how your gains and losses are taxed under AMT. If you had incentive stock options, there can be differences. Certain types of passive activity loss deductions will affect your AMT calculations, as well as depletion, intangible drilling, and private activity bonds. All of those are things that can cause you to pay AMT and have an entry on line 45. Of course, line 56 is self-employment tax, and I'm not going to explain the rules for that today, but if you have a net profit from self-employment, farming, active participation in a partnership, certain 1099 miscellaneous compensation, or wages of certain church employees, that is a tax you may be subjected to. Next up, we have Social Security and Medicare tax from Forms 4137 and 8919. Form 4137 is the form on which you figure the tax that you owe on your tips. If you received a W-2 with a number in box 8, allocated tips, you have to file this form unless you can show that you have a tip log that proves you reported all of your tips. If you didn't report your tips and there's a number in box 8, you're going to have to attach this form to your return. And for more information about how to fill that form out, you can check out our CPE course called Investment, Wage, and Other Income. Now on to a form I am going to spend a little bit of time talking about. This is Form 8919, and in the world of tax law, this is a newcomer. It's only been around for a few years. I can't peg the exact time frame, but I feel like it's 5 to 7 years it's been around now. And if you worked as an employee, your employer is, of course, required to give you a Form W-2. Thing is, there are employers out there who either don't understand payroll laws or choose to ignore payroll laws. Small business owners can be guilty of it, but I've seen larger corporations also do it. And it's all in an effort on the part of the employer, usually, to escape their tax liability for payroll tax. Sometimes they don't want to carry workers' compensation insurance. Sometimes they just don't want to pay the tax. Sometimes they don't know any better. But the bottom line is, at the end of the year, a worker who was in fact an employee has just been handed a 1099 miscellaneous. Now, in the course of our work as tax professionals, do we ever see that happen? All the time. All the time. My customer will come in and they've got 2, 3 W-2s and then bunk, a 1099 miscellaneous. Okay, did you start up a new business? What business are you in? Oh, I don't have a business. That was just one of the part-time jobs I had this year. Okay, so immediately now it's time to stop and explain to the client what it means when they get a 1099 miscellaneous. Now, sometimes when people get 1099 miscellaneouses, they've had a conversation with their employer that goes something like this. Employer says, hey, employee, I'll give you this job, but I want it to be a relationship where you're going to take care of your own taxes. So I'm not going to hold anything out, and I'll just give you a gross check, and you'll be responsible for paying your own taxes. How does that sound? And the employee goes, sounds okay to me. I'll do that. Because they don't know any better. They want the job, and if that's a condition of getting the job, they'll say sure. And then they come in several months later to get their taxes done, and they find out that they owe money out the wazoo. And at that point, they might start to get upset, or they might say, well, you know, that was what we agreed on. I guess it's my fault. The thing is, and this is the favorite This is one of my favorite analogies. The payroll laws that exist today are the result of legislation, and the legislation has been a result of efforts by unions and workers' rights organizations over the past century. And I remember as a child watching a movie with Marlon Brando called On the Waterfront. I don't know if any of you have seen it, but it's not a movie I've seen in many, many years. I saw it once in my life, and I was probably about 15, and it's a black and white movie. I remember watching it in the basement, and it was very emotionally impactful. And in that story, we had, of course, people working on the waterfront in very, very bad conditions. They were being beaten. They were not being paid properly. You could list all kinds of things. And so the unions first formed. And those unions lobbied for a lot of things, among which was being paid in a certain way. And so the laws that we have today have all evolved from those early days. None of us around today working had anything to do with the creation of those laws, but we can look back in time to see where they originated. Here today, we just live and operate under them, and it's an everyday way of life. We assume as employees we have certain rights. And so the laws are there to protect those rights, and those rights cannot be violated because a potential employer tells you that they don't follow the law. Now let's look at the analogy that I like to use. The analogy is I come to a red light at a busy intersection, and I don't want to stop at that red light. It's boring. I'm in a hurry. So I roll down the window of my car and I yell to the guy next to you, hey dude, we're going to have a new law. You and me, no more stopping at red lights. We're going to go through that intersection. Now, when I give you that analogy, you go, well, that's ridiculous. You can't change the law. Red means stop, green means go. Everybody knows that. And in that same respect, an employer and an employee cannot between them agree to change the law. The law is the law. So then the question remains, all right, how do you know if you have an employee and when you don't? And then you could say, well, it depends on the facts and circumstances. Isn't there something that says if it looks like a duck, quacks like a duck, moves like a duck, waddles like a duck, it's probably a duck, right? So that's how they establish whether or not you have an employee. If they behave like an employee, they do things the way an employee does, there's control of the employee by the employer, then they're probably an employee, regardless of what the employee and the employer between them agreed upon. All right. So what's this 8919 about anyway? Well, the Form 8919 is used when a worker has been issued a 1099 miscellaneous, and they should have in fact been issued a W-2. Thing is, life is not that simple. IRS created this form, and when it first came out, I went, hot dog, my problems are solved. But when you read the form, it's got this little caveat on it, a big caveat. And as a result of that caveat, ever since this form came out, I've had 0 customers willing to file it. Now you can tell by the way I give this speech that I've given it before. And I've given it multiple times a season to multiple customers of mine. And I sing the song with the greatest of enthusiasm in the same way every time, and I've got 0 people willing to file the form. Let's find out what the problem is. I've even had discussions with people at IRS about this form, and they go, really? We haven't heard anything about that. But I guess they're not on the front lines as I am. So what the deal with the form is you have a worker who says, all right, I really was an employee, and yes, I agree that the payroll taxes that my employer should have withheld from my pay were not in fact withheld. And if my employer had withheld my taxes, my employer would have held my share of Social Security and Medicare tax and would have made a matching payment of their share of Social Security and Medicare tax for me. And since they did 0 withholding, 8919 allows me to declare that I received wages on a 1099 miscellaneous and that I am now going to pay the Social Security and Medicare tax that should have been withheld from my pay and was not, my share. Sounds very straightforward and simple. The only problem is you're only allowed to use the form if you meet the tests. And here are the tests. You have to pass one of these. And the first one is you have to file Form SS8, Determination of Worker Status for purposes of federal employment taxes and income tax withholding, and received a determination letter from the IRS stating that you are an employee of the firm. Well, if that didn't happen, let's move on to the next one. You have been designated as a Section 530 employee by your employer or by the IRS prior to January 1, 1997. Or you received other correspondence from the IRS that states you are an employee. Or you were previously treated as an employee by the firm, and you are performing services in a similar capacity and under similar direction and control. Well, I can tell you, I actually worked for a company that went through a transition, and when I was hired by them, I was given a W-2, and I was given paychecks with withholdings, and then they decided to reconfigure the entire country and start issuing everyone 1099s. That would have been the box I would have checked. Your coworkers are performing similar services under similar direction and control, and they are treated as employees, but you are not. Your coworkers are performing similar services under similar direction and control, and they filed Form SS8 for the firm and received a determination letter that they were employees. Or, finally at the bottom, which is the one, if you're going to do it, this is probably it, you filed Form SS8 with the IRS, but they have not yet replied. Okay, so that's telling me if I file Form 8919 and none of the other items above it apply, then I'm going to have to attach SS8 and send it in at the same time, right? So what's SS8? Well, here's the 8919 first, and you can see that on 8919 it asks you to enter a reason code in column C. You can see here, enter the reason code here. And then you go up and you see the reason codes. Reason A, I filed an SS8 form and received a determination that I am an employee. And we go through all of the other reasons why you might qualify. And the final one is Reason H. Oh, so I received a W-2 and a 1099 miscellaneous. Oh, I filed, here it is. Well, anyway, you got to pick one of these reasons. So you enter the reason here. And, of course, if you haven't already filed SS8, you're going to have to file it. So we go down the form and find what SS8 is about. So SS8 is a form that you file with the IRS, and it is used to establish whether or not you are an employee. It's essentially a challenge to your employer. I think I am an employee, and here's all the reasons why I believe I'm an employee. And you send it to the IRS, and the IRS reads it, and guess what then happens? They go out and visit the employer and determine whether or not you are in fact an employee. Well, most workers do not want to go anywhere near having the IRS probe into their personal business. Also, they might be afraid that they're going to lose their job. So they say, forget it. I'll just file Schedule C and pay all of the tax. And that's what every single client I've ever done a tax return for that I have recommended they file this application has done. They have refused to file the application and just said, I want to pay the tax. Fill out a Schedule SE, I'll pay the tax. It isn't worth it to me. I've even had people who were fired by the prior employer. I've had people who only worked there for a short period of time. They all refuse to do it. As soon as they see they have to enter and disclose all of this personal information about themselves and their relationships with that employer, and that the IRS is then going to do an investigation, to them it is not worth it. They don't even want to begin to pry open that lid and see what's going to come out. So now, let me see. One way that this could work is I could not fully explain to my customer what's going to happen. I could interview them. I could fill out the form, being very blasé about the whole thing, being very unspecific and very general about what's going to go on, have them sign it without them really understanding what I'm doing. Then maybe they'd go for it. But when I take the time to explain to them exactly what will happen, they don't want to do it. Now, I do want to talk here a little bit about what facts and circumstances the IRS looks at in determining whether someone is an employee. And this information actually comes from a very short but nice IRS publication called 1779, Independent Contractor or Employee ? And it says that the courts have considered many facts in deciding whether a worker is an independent contractor or an employee, and these relevant facts fall into three main categories: behavioral control, financial control, and the relationship of the parties. No one of these is all-consuming or all-determining. Again, we're going back to that analogy. If it looks like a duck, waddles like a duck, and quacks like a duck, it's probably a duck. And that's what they're going to do. They're going to look at behavior, financial, and relationship of the parties. And here is the SS8. So let's just take a look about what it is asking for. Firstly, it says who is filing the form? The firm or the worker, because either one can file it. Now, a firm might want to be careful. Maybe they think that they could be in a situation where they have independent contractors, but they're worried someone's going to come along and dispute it. So ahead of time, they actually file for a worker determination with the IRS. They could do that. But I would bet that most of the time it's workers who file the form. Question? No. No, I've never seen a firm do it. Yes. Okay. So I've got a person in my classroom who's recounting an experience that she observed here in Oregon with Nike and Intel, and how those organizations were bringing in contractors and treating them in the same way they treated any other employees, but the contractors weren't receiving benefits. And so there was a lawsuit, and she's speculating that maybe this system evolved out of that, or this Form 8919 evolved out of that. It could certainly have evolved out of that as well as other things, but I do know for a fact that the way large companies like Nike and Intel get around these rules is by using employment agencies. And we do tax returns for a number of employment agencies, including agencies that work with big companies like this, and they are specifically a vehicle for avoiding hiring workers that end up being entrenched into their benefits system. It's one of the marvelous things I've observed about the United States. I come from Canada, and in Canada, you get paid vacation as a matter of fact as soon as you start your work. It's the law. Everyone in Canada gets 2 weeks vacation. Now in Australia, it's 6 weeks vacation. And in Europe, I think it depends on the country, maybe 4 weeks vacation. So the United States is a first world country, and it's the only country I'm aware of that does not have a law requiring workers receive paid vacation. So this country has basically allowed or created a situation where employers can come in who start up employment agencies for the sole purpose of hiring workers, sending them to facilities on temporary assignments, and when those assignments end, those employees move out, never having been able to entrench themselves into the benefit system of the company they contracted into. So that's what I've observed. That happens too. We're just getting another comment about some contract labor. It's just you can't hire people except through a temporary agency because it's impossibly expensive otherwise, because your insurance will go so high as an employer. At any rate, let's take a look at the SS8 form itself. And you will see in Part 1, they're asking for general information about the worker. And then in Part 2, they're asking for information to indicate behavioral control. There are all kinds of questions about how you showed up to work each day, who told you what to do, who was in control of your work. Then we have financial control. Who really ran the finances of the business? Did you pay to advertise the business? Did you write checks to pay service providers? Who was handling the money? And then they get into questions about relationship of the worker and the firm. So you can see it's a fairly lengthy application. And when my clients take a look at it, they spaz out. They say, no thanks, file Schedule SC, I'll pay the self-employment tax. All right, next in line we have additional tax on IRAs and other retirement plans, etc., line 58. And of course, if you took an early distribution from a retirement account and there is no exception to an early distribution penalty that applies to you, you will either enter an additional 10% tax on the early distribution on line 58, or if the distribution came from certain simple plans within the first 2 years of setting up the plan, then the distribution is 25%. And we talk quite a bit about that in our class called Pension and Social Security Income.
Password number 1 is Waterton, W-A-T-E-R-T-O-N, Waterton.
Next topic in line is household employee taxes. If you had a household employee during the year, you may be required to pay Social Security and Medicare taxes for that employee. Now, the nanny tax is another one. Just like we have employers that give their employees 1099 miscellaneouses when they shouldn't, I would say equally as large and a little less obvious is the world out there of parents who need nannies, who hire them and somehow think that payroll laws don't apply to them. In fact, most of the time I would say it's just largely ignorance. They have absolutely no clue that they've just hired an employee. They've hired someone to take care of their kids. Why would that make them an employer? They don't think that far. But interestingly, this is a well-seated rule, and if you watch the news regularly, over time you will observe that not too infrequently some rather well-known politician gets in trouble for violating the nanny law. So I think there's been at least 1 or 2 governors of California that have gotten in trouble or even lost office over this. I know that there was a woman who was being considered for a key position with the Obama administration, and people started sniffing around her nanny, and she pulled out before it could even open that can of worms. All right? So the only time we really hear about the nanny law or even become aware that it might be there is by paying attention to the news. And when you hear a story about so-and-so had a nanny and apparently there was some tax situation with that nanny, I know exactly what happened. I don't need to hear any more. They paid that nanny cash. They didn't give them a W-2. They didn't pay payroll taxes on that nanny. That's what it amounts to. Now, the IRS does have a system in place so that you don't have to W-2 every babysitter you ever hire. So you want to go out to the movies with your spouse and enjoy a night out on the town, and you pay the next door neighbor's teenage daughter $8 an hour to watch your kids so you can have an evening on the town. Are you going to have to W-2 her? Probably not. There is kind of this window where it's safe. So they do have a point where you can have babysitters and you're safe. But if once you cross that threshold line, you are required to file a Schedule H or a Form 941 to pay your payroll taxes on your nanny. So what is that threshold line? Well, you are required to pay payroll taxes for your household employees if you paid $1,700 or more to any one household employee during the year, or you paid $1,000 or more in any calendar quarter of 2010 or 2011 to all household employees. So it stands to reason that if you paid $4,000 or more in wages during the year to all of your babysitters combined, that in at least one of those quarters you would have hit $1,000. So you would be required to file it. Or if you look at all of the people you employed as babysitters or nannies in your home throughout the year, that you can show at least one of them received $1,700, then you're going to have to issue that person a W-2. If you are an employer who is required to pay payroll taxes, you must apply for an employer identification number and issue a W-2 to every employee to whom you paid $1,700 or more during the year by January 31, 2012, and file Forms W-2 and W-3 with the Social Security Administration by February 8, 2012. Now, how many of our typical household owners, household families who hire a babysitter are going to have the remotest idea how to do it? Well, that's our job as tax preparers. So our client comes in and we say to them, did you pay any child care expense during the year? Because we're, of course, looking for the credit, looking for the deduction. And the answer is yes. And then you say, okay, I need the information, of course, for filling out the form. We need the name, the address, the Social Security number of this person. And then you say, oh, you paid an individual. It wasn't a business, like KinderCare. It was an individual. Nancy Smith. Okay, Nancy Smith. So does Nancy Smith run a child care business? No, Nancy Smith is our nanny. Oh, really? You have a nanny. How nice for you. Let's talk more. So now we're going to be getting into, did you issue her a W-2? Did you pay the payroll taxes? Well, if you didn't issue the W-2 and the payroll taxes, how much did you pay her? Let's see, we're below that $1,700 number. But if you come to the point where it is in fact the case that it has to be done, that's our opportunity as a tax preparer to explain that it needs to be done and start helping them make it happen. Now you can apply for an employer identification number with your client over the internet while they're sitting there with you. It takes just a few minutes. The Schedule H is something that you could then prepare, and of course it may be late. They should have delivered that W-2 to their nanny a few weeks ago, but better late than never. So you can help them take care of all of that. Now, as an employer, you are responsible for withholding and paying Social Security and Medicare taxes for your employees. You should, of course, withhold 4.2% of gross wages for Social Security tax and 1.45% for Medicare tax. And of course, this 4.2 number is low. It is supposed to be 6.2, but we have a payroll tax break for workers in place for 2011, and it's been extended all the way through 2012. So for 11 and 12, the rate is 4.2 rather than 6.2. But of course, the employer share is still 6.2. And then if you and your employee agree to do it, you can also withhold income tax for your employee, but there's no requirement that you do so. There is a rule that says if an employer is responsible for withholding payroll taxes and they don't do it, that they can be forced to pay it anyway. So if you're the employer on the audit side, when IRS decides to come out and audit you as an employer, and they determine that you've had workers to whom you should have issued a W-2 and done payroll withholdings that you failed to do, they can make you pay the payroll withholdings even though you didn't withhold them. So for an employer, it's pretty expensive to get caught not doing withholdings. Now here's an illustration of how you complete Schedule H. Schedule H is one of the methods you can use to pay payroll tax. Of course, the other one is to just file the payroll report 941 and also 940. And in lieu of those, you can attach Schedule H to the return. Here we have Julia. She is employed as a nanny to care for her 2 children. She paid her nanny $12,000. $3,500 was before July 1st, and $8,500 was after June 30th. And during the year, she withheld $500 of income tax and 4.2% Social Security tax and 1.45% Medicare taxes from the wages that she paid to her nanny. Julia paid a state unemployment fund contribution of $144 to her state, and this is her EIN. After completing the state payroll report that she needs to file with the state, Julia should also prepare and file Schedule H as follows. And here we have some questions that appear in this first section right here. Did you pay any one household employee cash wages of $1,700 or more during the year? And in this case, we're going to say yes, because of course she paid $12,000. So we check that box. And then on line 1, we enter the cash wages paid and multiply that by 10.4%. 4.2 is the employee share and 6.2 is her share. We multiply that out, and that's the amount she needs to pay. So what you can see here is if she fails to withhold the employee's tax from that employee, she's still responsible for paying it. It's right on the form. There's a question in the classroom about what happens at the state level, and that's dependent on state law. Now in Oregon, the state of Oregon has one annual report that can be filed for household employees. But it is a good point. At the state level, pretty much every state in the country is going to have a state unemployment fund that you need to be paying into as an employer. And so for your state, those of you who are in attendance who are not from our state of Oregon, you should be inquiring with your state's payroll requirements for household employees. Do they have quarterly reports that need to be filed when you have household employees, or do they have an annual report? How do they want you to go doing that? You need to check up with that. So we looked at line 2, which is 10.4% of the wages paid. Then on line 3, we enter the amount of wages subject to Medicare tax, and that was another $12,000. We multiply that by 2.9%, which is, of course, the employee's share of 1.45% and the employer's share of 1.45%. Multiply that out and we get 348. And again, what you're seeing is the employer's failure to withhold the tax from the employee's wages does not mean that the tax does not have to get sent by the employer to the IRS. Next in line, there was a voluntary withholding of $500. We've entered that on line 5. And the total amount of lines 2, 4, and 5 combined is $2,096. Next step is to go over to page 2. And on page 2, it asks a series of questions. It says, did you pay unemployment contributions to only one state? Most household employers would say, yes, I've only lived in one state, but I suppose if you moved during the year and had a nanny in 2 states, then you would have 2. But most household people are going to say only 1. Then it says, did you pay all state unemployment contributions for 2011 by April 17, 2012? So in order to fill out this part 2, this section right here, you need to be able to say, yes, I filed my state payroll report, and yes, I have paid my taxes or will pay my taxes on time for that state payroll report. I need to be able to say that I did that. And then line 10, where all the wages that are taxable for FUTA and also taxable for your state unemployment tax. So in this case, we're going to say yes. They're all taxable by both FUTA and the state unemployment tax. FUTA is, of course, the federal unemployment tax. So we're going to answer yes to all of those questions. Then it says, how much did you contribute to the state unemployment fund? And in the wording of the problem, I told you that's $144. Line 13, it says total cash wages subject to FUTA. Well, it happens to be that the maximum amount of wage typically subjected to FUTA tax at the federal level is $7,000. So whether you paid your employee $12,000 or $100,000, it tends to be the case that line 13 will always be a maximum of $7,000 per worker. So if you have only one employee, it should never be more than 7. And then the math says take this number, 7,000, and multiply it by 0.006. And when you do that, you get $49. Now there is 2 rates in play for the year. For 2011, there were 2 rates, 0.008 and 0.006. And in the earlier part of the year, it was 0.008. And in the later part of the year, it was 0.006. And so in the wording of the problem, I just told you she had $3,500 at the early part of the year, and then after July, or beginning July 1st through December 30th or 31st, she paid the remaining pay for the year. But FUTA is only assessed on the first $7,000 paid. So we end up with total FUTA tax of $49. Now the next section we have here applies if you didn't pay into the state employment tax fund. And if you didn't do that, or if you paid taxes to more than one state, you have to do Section B, and it's a more complicated section. In addition, if you didn't pay into the state unemployment fund, the federal unemployment rate goes above these 2 amounts here, 0.008 and 0.006. You can go much higher than that if you were not paying into the state fund. Then we have total household employment taxes, where we're adding up the FUTA, the FICA, and the federal income tax withheld, and when we're all done, the amount of tax that we need to pay for Julia, or that Julia needs to include on her tax return, is $2,145. And she will, of course, check that she's attaching a Schedule H to her return and enter this on her Form 1040. And if we go right back up to page 2 of our manual, she's going to check, or not check the box, but she'll enter on line 59A, the household employment tax, and she will enter that tax amount on line 59A. They used to have a checkbox. Now they've just got a line for it. So moving on to the next page, page 17 in the manual, estimated tax penalty. Now it stands to reason that you can see the amount of tax owed on that $12,000 of nanny wages was fairly substantial, over $2,000. And in a situation like that, you could have a taxpayer find that they well owe with their return, perhaps more than they want to owe. And therefore, they should be on top of the fact that when you do have a household employee, you either need to bump up your withholdings on your job or start making quarterly estimated tax payments. And if you fail to make the quarterly estimated tax payments, and when you file your return you owe $1,000 or more, you may owe an estimated tax penalty. Okay, so the next topic of today is, of course, the repayment of the homebuyer credit. And I've been teaching about the first-time homebuyer credit for a while now. It, of course, came out in 2008. And it's a credit that at this point is applying to only a very small number of people. But if you happen to have a client who did claim the first-time homebuyer credit, you should be aware of the rules that apply. Now, one of the things is that if your client does not tell you they received the first-time homebuyer credit and you don't know about the first-time homebuyer credit, it's possible the IRS does know about the first-time homebuyer credit. After all, they are the one that processed that money and gave it to them. And there's some important rules to know about the first-time homebuyer credit. First of all, there were a total of 3 different credits. And the first credit that came out was the 2008 credit. And that credit was a maximum of $7,500 that was to be repaid over a 15-year period beginning with the 2010 returns. So $7,500 was given to the client with their 2008 return. And then the credit has to be repaid at a rate of $500 a year beginning in 10. Then, shortly after the 2008 credit came out, because it wasn't around for very long, it was only around for a few months, they passed another credit. And we called that one the 2009 credit. And the 2009 credit was expanded to be $8,000, and it could be, it didn't have to be repaid, provided the homeowner owns and occupies the home as their main home for 3 or more years. And then we had a 2010, or actually 2009 going into 10 credit. I believe it expired at the end, kind of midway through 10, like May or something. And that credit also provided for a long-term resident credit. So even though it's called the first-time homebuyer credit, there's a long-term resident portion of it, which was a maximum of $6,500 for people who had owned and occupied their homes, I believe, for 5 out of the last 10 years, and they purchased another home and made that home their primary residence. They may also have qualified for a credit. And that most recent credit, the one that included the long-term resident credit, has been expanded or extended beyond the expiration date of the end of May 2010 for people who are in the military. So it is possible that there are people, military people, who were actually still claiming this credit with their 2011 returns. So it's out there. There's probably thousands of people around the country who've claimed it. We've had a number of clients who claimed it, but the ones that we're really mostly concerned with are those 2008 people, because those are the ones that we know are on a repayment plan. For everyone else, there's only a need to repay if they fail to live up to the terms of that credit or the agreement for receiving that credit, which is they live in their home as their main home for 3 years. So if you don't fail to meet that test and you do in fact live in the home for 3 or more years, that credit never needs to get repaid. But for the 2008 people, things are a little bit different. And in general, the IRS says you have to live in your home for the 3-year period. And then if you sell your home before the 3-year period is up, or if you are taking out the 2008 credit, when you sell that home, you may have to do a recapture. So for either the 2009 or 2010 credits, there's a possibility of a recapture if you sell your home or cease to use your home as your main home within the 3-year period. And for the 2008 credit, there is a recapture when you sell as well. So let's look at the rules for this recapture. The first one is you sold the home, including through foreclosure and repossession, to a person who is not related to you and had a gain on the sale. If you sell the house to someone who is not related to you, the repayment in the year of the sale is limited to the amount of gain from the sale. The amount of the credit in excess of the gain does not have to be repaid. Now, there are other situations where you could still have a recapture. I'll let you read those on your own just because of time's sake. But if you are in a situation where you do have a credit recapture because you sold the home, there is a worksheet, the Form 5405 gain worksheet, that needs to be completed. And I have a cutout of it here in the manual. And we're going to go down and take a look at an illustration of how to fill that form out and redo the recapture on your 1040 form. The example is at the bottom of page 19 in your manual, and it says, Johnny sold too soon, received $7,500 as a 2008 first-time homebuyer credit. He purchased his home on July 1st, 2008 for $250,000, and his adjusted basis in the home is $242,500. Where do we get that number? We take the purchase price and reduce it by the amount of credit that he claimed. Then Johnny repaid $500 of this credit with his 2010 return, as he properly should, because beginning in 2010 he has to repay $500 a year every year for 15 years, or until he sells the home. Now, because he sold the home, we're concerned with figuring out how much his profit on the sale is, because to the extent he has a profit on the sale, he's going to have to recapture the remaining amount of credit. So let's take a look at it. He sells the home on June 30th of 2011 for $253,000, and his expenses from the sale totaled $4,500. His net gain from the sale is figured as follows. Purchase price of home, $250,000, minus the 2008 homebuyer credit, plus the amount of recredit he's repaid. So that gives us his adjusted basis in the home. And of course, adjusted basis is much more complicated than that, but we have a whole session about figuring basis in property. I'm trying to keep this one simple. We then move over to the sales price of the home, which is $253,000, and look at the selling expenses he had, which was $4,500. We subtract $4,500 from $253,000, and we also subtract his adjusted basis. And when we're done, we have his profit, $5,500. And that is the amount that he needs to include on his return as additional tax, and he needs to pay that tax with his return. Now here is the Form 5404 or 5405 gain worksheet completed. And the way the worksheet works is a little bit differently than how I computed it. All in all, the point is that they want you to get to that $5,500 number. On the worksheet, they say start with the selling price, subtract the selling expenses, then get the amount realized on the sale, subtract out your adjusted basis, enter the amount of first-time homebuyer credit that has not yet been repaid, and when you're all done, you get the same number. So whichever method makes more sense to you is fine. We then go over to the form itself, and when you sell your home or dispose of your home that you have to do a recapture, then you need to attach Form 5405 to your return. Now, if the only thing you're doing is reporting that $500 repayment amount each year on your return, you don't have to attach the form. You can just enter $500 on the line on your tax return, line 59, and you're done. So 5405 is really only filed to report a recapture of more than the normal $500 repayment amount, or to claim the credit in the first place. So if you do have a military person who was eligible to claim the first-time homebuyer credit for a home that they bought in 2011, you would attach the form for that as well, because it's a two-purpose form, sale and purchase. And then in Part 4 of the form, well, actually Part 3 of the form, we say I sold the home to a person who is not related to me, and I had a gain on the sale as figured in Part 5 below. And we go down and fill out Part 4. In here we enter the amount of the recapture, and of course the recapture carries to line 59B, and we've entered it on the 1040 form. There's a question from Stephanie. Is the homebuyer credit to the day from purchase for the 3 years or 3 calendar years? It's the day of purchase. So you purchase the home, and you have to then move into the home and occupy the home for 3 years. And so, no, it's not 3 calendar years, it's three fiscal years, I guess you could say. Well, not 3 tax years either. You have to have been in the home for 365 days times 3. That's it. All right, next line on the 1040 is line 60. This is a new line. Anything new is exciting, don't you think? This is a really exciting line because it's new. So the IRS now provides a dedicated line for entering taxes that are not separately identified on another line of the form. You identify the other tax you are reporting with one of the appropriate codes, and if you need room for more than one code, obviously you need to attach a statement. One of the codes that is possibly a code that you would come across and use, because most of these codes are pretty obscure, but this is one that I think would pop up, is the additional tax for HSA distributions. If you have an HSA or an MSA, the additional tax on distributions that is not used for qualified medical expenses has been increased from 10% to 20%. And the 20% penalty applies to distributions after 2010 that were not for qualified medical expenses. You do not have to pay this additional penalty if the distribution occurs after you reach age 65, or because you became totally disabled, or because you died. But if you are required to the penalty, or required to pay the penalty, you need to complete Form 8889 to figure the taxable portion of the distribution, and whatever that taxable portion is also subject to the penalty. And you will enter the 20% penalty on Form 1040, line 60, and enter the code HDHP in the space provided for on the line. Now here is all of the other possible additional taxes and the codes that go with them. And then in this space right here, I've entered the name or number of any additional forms that you might be required to complete and attach to the return as well. And of course, we have MSA, which requires Form 8853, and HSA, which is the first one we covered, 8889, and so on. And I am definitely not going to read all of these potential other taxes to you. I'll leave those to you for your reading pleasure. And we'll move on to the next topic of the day is, all right, I'm finished calculating my taxes. Do I have a refund? I love telling my clients I have refunds. The bigger the better. Makes me feel like Santa, and they're always happy when they have a refund. Well, I have the few odd ones who go, why do I have such a big refund? I need to reduce my withholdings. That's bad. I have the odd one who says that, but it's rare. Most of the time it's, whoa, that's great. Or is that all? I get another one like that. Is that all? All right, so we got the refund, maybe, or maybe we owe. And we're going to start with the positive side of things. I have a refund, now what? If you have a refund, you will need to decide how you want to receive your refund. There are a number of different ways that you can go about receiving your refund. You can use your refund to purchase U.S. savings bonds or to pay estimated tax. You can have your refund mailed to you, or you can choose to have your refund deposited into one or more bank accounts through direct deposit. Now, if you want to do direct deposit, you simply fill out the direct deposit section at the bottom of the 1040 form. And on the long form, it is lines 74B and D, and then you would check the type, either checking or savings, on 74C. Now, what can I say? I could talk about this line for a great while. So I've been doing taxes now in my 20th year. Most of you have heard me say that by now. And I would say, you know, as an owner of a tax business, there are certain things in life that will upset a customer. And one of the things that will upset a customer is when their refund does not show up when it's supposed to. My refund is 1 hour late. I'm going to get a phone call. My refund's not due for a week, but it's not here. I know she told me it wouldn't be due until the 20th of the month, and today's the 10th, but I'm going to call her anyway and find out where it is. So believe me, when it's past due, the client is starting to get worried. And what are some reasons that a refund could be past due? Well, there's all kinds of reasons it could be past due, and we'll talk about some of those a little bit later. But one of the reasons a refund can be late is, well, we didn't put the right number on the form. So this is a training issue I've had with my staff for many, many years about procedures that we've enacted in our company to ensure that we get the right numbers on the form. And if these procedures are followed to the letter, we don't have problems with our clients not getting their refunds. Well, except once or twice. Once I had a client who, after we filed the return and didn't receive their refund and did some tracking to figure out why they hadn't gotten their refund, discovered they had given us a check off the account that they had closed. So you can have all the security measures in place in the world, but if your client gives you a check for an account that they closed, that's not going to work. And I think I also had a client who had a valid account and then went and closed it before the refund was deposited. So I've had clients just do wacko things like that. But in general, let's assume our client has a valid account and they're providing us information for direct deposit. How do we ensure they get their money? Well, one of the security procedures I have in place is that I want to see a canceled check. I want them to give me an image of their check or rip a check out of their checkbook and hand it to me. And the reason for that is the check contains the numbers I need for setting up direct deposit. On this line at the bottom of the check, you can see we have a routing number, and then we have two slashy bars on either side. And then we have another number here with some little brackets around it that make it look confusing. Is the account number 202020-86, or is it just 202020? That can be confusing. But ultimately, the way to determine what the account number is to find the check number. If you identify the check number and you identify the routing number, everything else that's left is the account number. So it's just a good rule. And then you look up at the 1040 form and it asks for the routing number. All routing numbers are 9 digits long. So this routing number is 9 digits long and it needs to go up here. And then all the rest of it that is account number goes here, and there's no set law on how long an account number can be. They can be 5 digits long, they can be 20 digits long. It's up to the bank. So you enter that there. Then what I do is I actually copy information directly from the check into my computer screen. As I'm looking at the check, I'm typing it in, and my computer screen asks me to enter the check twice. So I do that. Then I actually process the tax return to look at the finished 1040 with the numbers from the check filled in on the form. I look to see them there. That tells me that the software has implanted the account number in the first place. And then I hold the check up to the computer. Actually, I even do better. I have a worksheet that I use, and I copy the numbers from the computer onto my worksheet. And then I staple the check to the worksheet, and I circle the account number on the check, I circle the routing number on the check, and I draw arrows to the numbers on my worksheet. And I have my client initial that those are correct. That is the procedure we use in our company, and it has been very successful. As I said, the only time we ever have a problem after that is when customers do silly things like close their accounts. Now, sometimes they don't receive their money at all because, well, for another reason I'll talk about in a minute. But procedurally, that's what I have people do. So that's if you're setting up a refund to go into a single account. Now, what if my client doesn't have a checking account or doesn't want to use their checking account? Well, I actually don't like that because I like to have that check. But if they don't have a check, then what I will do is I will have them take that worksheet I mentioned. It's just an internal worksheet we use in our company. And I'll have them take it to their bank and have the bank fill the information out on it for me. Or I will have them go to the bank and get a statement from the bank specifying what the correct routing number and account number is. That's the security process I like to have in place. And if my clients don't want to do that, then essentially I'm having them sign off on the worksheet that the information I've entered in the computer is accurate and they're taking full responsibility if there's a mistake. So I'm very particular about that. Now, having said that, it isn't always the case that you can 100% depend that the numbers on the check are correct. If you're dealing with a bank, the numbers on the check are always good. But if you're dealing with a credit union, unfortunately, these little credit unions like to do things their own way. And sometimes the numbers on a check for a credit union are perfect, but just as often, the credit union either adds digits to what's on the check or drops some of the digits on the check. Now, my experience has been that if the credit union prefers that you drop digits or add digits, and you don't do either of those things, and in fact use only the digits that are on the check, they're probably going to get it in the account anyway. But because procedurally IRS, when I first got into this business 20 years ago, the local electronic filing coordinator here in Portland, Oregon, her name was Kathy Owl, she made a point at all of the tax practitioner liaison meetings she ever taught about e-file 2, that if we had a credit union check, we'd better be careful. I'm still remembering this conditioning that she's given me all those years ago. So for every single credit union that's in our local area, we have called either during the client interview or after the client is gone to verify the check and to make sure that the numbers on the check are good. And if they're saying, no, you need to add this digit or drop those digits, we do that. And we've actually created a spreadsheet of all our local credit unions and the procedures they have. So that's just our measure, and we've never had a problem with a credit union as a result of being very careful. Now, that's for direct deposit into a single account. It is possible to have your refund deposited into more than one account. You can split it and have it go in two directions. And to do that, though, you need to attach Form 8888. It's also possible to have some of your refund used to pay, buy Series I savings bonds. And again, if that's what you want to do, you have to attach Form 8889, or 8888, sorry. And this is the Form 8888. You can see it allows space for 3 accounts. It also allows space to enter your U.S. savings bonds that you want to purchase, whose name is going to be on the bonds. And then it says, how do you want to receive the remainder of your refund? You can get it as a check down here or as a deposit up here. And oddly enough, they have you do some math. The refund I'm going to have deposited plus the refund that I'm going to have issued as bonds plus the refund I want to receive by check needs to be the number on line 8. And the number on line 8, that needs to be the refund shown on my tax return. So they're having you do some very simple logical math there. Now, I did say it is possible a client did not receive the refund even though direct deposit was set up perfectly in the computer. And that happens sometimes when there is a refund offset. A refund offset occurs when the taxpayer owes money either to the IRS for back taxes or because of a debt that is collected upon by the Treasury Financial Management Service, or FMS. The types of things that FMS collects on include child support and student loan debt. Those are the big ones. So a person can have their refund taken to pay back federal taxes, back state taxes, student loans, and child support. Those are the big ones that FMS will collect on. If an offset occurs, the taxpayer will receive a letter. The letter will tell them the original amount of their refund, the amount of the refund that was taken to pay the debt, and the name of the agency that received the money. FMS will not be able to tell or help or refund any money that was taken incorrectly. Once that money has been taken by FMS, it sends it to the agency, and the taxpayer has to contact that agency directly to engage in procedures to either recover the money or discover that there's no hope of ever recovering the money. Now, one of the things I do see tax filers do is they know that they owe on a student loan. That's a big one. I have $10,000 in student loans, and I've been paying on them over years. I finally got it down to the last $1,000. I've been in collection for a while. I've been getting these notices, but it's down to $1,000. I have a $5,000 refund coming, and I don't want them to touch it, so I'm going to run out and pay my student loan off tomorrow and then file for a refund. And then guess what happens? the refund still gets $1,000 garnished because it takes several months for these two systems to talk to each other. So the last thing I ever recommend a client do is run off and pay one of these debts off. I tell them, you know, if the debt's going to be garnished, let it get garnished. The system will eventually figure itself out. And if you get double garnished because you did things out of time, I have no control over that. Yes? What's the order of debt? Taxes always get paid first. So if you have taxes owed in earlier years to IRS, IRS will take their share. And once IRS has taken their share, if there's anything left, then it would go to child support and student loans. But the exact order of that side, I'm not sure. And I've had clients not that long ago when we had debt indicators coming in from the IRS, we would see an indicator of I for IRS debt and an indicator of F for FMS debt. And I frequently had clients that had I and F combined. You can tell they had charge of their financial lives completely. All right, the next one we're going to talk about is injured spouse. Because one of the reasons why you might lose your refund is that you've just filed a joint return with your spouse and your spouse owes money. You don't owe any, but your spouse does. And you've just filed a joint return that shows that you have a refund coming, except you're not getting your refund because your husband owes money and they just took your refund to pay his debt. Would that tick you off? Yeah, well, most people it does. And it depends on the marriage. Sometimes when people get married, financial life is one and the same. They accept their joint debts. They understand about the joint debts. They're working together as a team. And if the debt, if the debt is offset with the non-owing spouse's refund, that's accepted because best get it paid off. But in other marriages, I see more of a separation mentally of finances. They keep their separate bank accounts. They have their separate jobs. They can be married for 20 years, and everything is still this is mine and that's mine. And then they file a joint return, and my refund just paid your debt. That's not right. So a temptation to avoid that might be to file separately. That would certainly be a solution. But filing separately might mean that you don't get to claim an education credit or the earned income credit or the child or dependent care credit. So filing separately is not a good option. But the IRS says you can go ahead and file jointly and then attach an injured spouse declaration to your tax return. Now the thing with the injured spouse declaration is the IRS frequently gets it submitted when it should not have been submitted at all. So in order to be eligible to submit an injured spouse application to protect the refund of a spouse who does not owe money from being garnished by the government to pay the tax of the spouse who does owe money, you have to be all of the following. Firstly, you have to be filing a current year joint return. The joint return that is in question is the one that the refund is being taken from. And the injured spouse is not liable for any of the debt, right? The injured spouse has not or will, or pardon me, the injured spouse has or will report income such as wages, taxable interest, unemployment compensation, etc. You can't be an injured spouse if you didn't work and you had no income. So your spouse could owe a ton of tax, but he's the only one working. He's the only one paying in. You can't claim you're injured if you didn't work and pay in, right? Well, you might complain, but sorry. The injured spouse will report payments such as federal income tax withholding from wages or estimated tax payments, or be claiming earned income credit or some other kind of refundable credit. So essentially what we're looking at is, on the tax return, the person is injured is a person who worked, earned money, paid into the system, or is eligible for a credit from the system based on their income. And if they can show all of those things, and they can show that their refund is being taken for their spouse's debt, they file the form. And you will see the beginning page of the form is merely a checklist. It's going through to verify that you meet the criteria for filing the form, which are what I just described. And then on part 3 of the form, we actually have 3 columns. We have amount of income shown on the joint return, the amount of income that is allocated to the injured spouse, that is the person who is filing the form, and the amount that is allocated to the other spouse. We have a line for wages. We have a line for all other income. We have a line for adjustments. You have to be dividing up the adjustments. You have to be dividing up the income. You have to divide up your standard or itemized deductions. You have to divide up the number of exemptions, the credits, other taxes owed, the federal income tax payments, and the amount of other payments. And you'll notice that nowhere on there does it actually figure what the injured spouse's refund is. Now you can kind of deduce what it probably will be, but the IRS is going to analyze the information provided on the form to determine how much of the refund is allocable to the injured spouse, and they will issue that amount. But it isn't a number that you figure and find on the form. Yes? There's a question, is it 50-50? Well, absolutely not. No. You're going to look, if the injured spouse earned $10,000 and the non-injured spouse earned $100,000, the injured spouse is going to put the $10,000 in their column. And it could be when they finally get to the bottom, they can't really show that they're injured at all. That's the purpose of the form. But if, on the other hand, you could have a situation where the injured spouse earned 20, the non-injured spouse earned 10, then you're going to have a division going the other way. Now, one of the things I do is I allocate all of the dependents to the injured spouse. That's something I always do, and the IRS doesn't seem to have a problem with that. But that's the one thing I have control over. Filing Form 8379. You can file 8379 in one of two ways. One way is to attach it to the tax return. And if you're filing electronically, this form can go out electronically. Now, sometimes it is discovered that the person is an injured spouse after the refund's been garnished. We didn't know that they were injured until IRS snagged their refund and they come in squawking. So if that happens, you can actually file the form after the return has been filed as a separate document. And because it can be filed separately by itself, you'll see that it has a signature area. There is a cautionary note here, issuance of the injured spouse's refund. Part 2 of the form allows you to request that the injured spouse's portion of the refund be mailed to a different address. And since the information entered on Form 8379 does not change the address of record, requesting the injured spouse's portion to be mailed to an address different than the address of record requires issuance of a manual refund that will delay receipt of the refund. The IRS recommends taxpayers to change the address of record by filing Form 8822, change of address, rather than completing Part 2 of the form. Now, what I can tell you is no matter what, when you file this particular Form 8379, the refund is delayed. You know, that refund that should have been deposited in 10 to 17 days, well, it's going to be more like 2 months, folks. So don't hold your breath. Amount you owe. So we talked about refunds and how you can get your refund and what might happen that caused you to not receive your refund. Now what happens if you just flat out owe? And how do you go about paying that? And what if you can't afford to pay? Well, if you owe a balance due with your return, you can pay the amount owing in any of the following ways. One is through direct debit from your checking or savings account. Another is through the Electronic Federal Tax Payment System, or EFTPS. You can click on this URL right here to take you to EFTPS. You can also pay by credit card, but merchant fees will be applied, and they will increase the amount you are paying out. Or you can just mail money. You can mail a check or money order, and if you do that, you need to attach Form 1040V. Now, the thing is, 1040V is not required, but the IRS does like it when you send it. They say it enables more accurate processing of the money. And of course, I always recommend to any client when they mail a check to write their Social Security number on the memo section of the check in case the check gets separated from the voucher or the return. Need time to pay? Well, because of the current economic recession, there's a lot of taxpayers out there who cannot afford to pay. And so there are a number of procedures in play, none of which are actually new, but maybe the conversations we're having about them are more frequent. The first one has been around for ages. That's the Installment Agreement Form 9465. This is the one form on my price schedule that's free. If I get to the bottom line and I tell my clients they owe and they can't afford to pay, I just don't want to make it any more complicated for them than I have to, so I don't charge for this form. On the form, we need to tell the IRS that they can't afford to pay and that they would like to pay in installments. And it happens to be this form has a guaranteed acceptance rules, so that if the form is filed, there are certain situations where the IRS will absolutely accept it. I don't know that I've ever had a client turned down, and frankly, but I'm sure lots of my clients don't meet the criteria, but essentially the IRS is triggered to accept the form. It's a very easy process. The IRS must agree to accept full payment of your tax liability in installments if, as of the due date you offer to enter into the agreement, the total taxes, not counting penalties, additions to the tax, or other additional amounts do not exceed $10,000. And that in the last 5 years, you and your spouse, if the liability relates to a joint return, have not failed to file any of the required income tax returns, failed to pay any tax shown on any such return, or entered into an installment agreement for the payment of any income tax. So what this is saying is if you're already under an installment agreement for an earlier year, you're not guaranteed that you'll be accepted for a second installment on a later year. They'll probably merge them together anyway, but they don't have to. Then number 3, you have to show that you cannot pay your income tax in full when due. The tax will be paid within 3 years or less, although I've seen people have payment plans that go much longer than 3 years. But the IRS says it's an automatic approval only if you can show you're set for 3 years or less on a payment schedule, and that you agree to comply with tax laws while the agreement is in effect. Well, in effect, these are just rules that state that if you fall within those parameters, the IRS must set up an installment plan, but the reality is they are much more flexible than this, and typically will give it to virtually anyone who is at least trying. But once you're on an installment plan, if you fail to live up to the terms of the installment plan, they can very quickly move to collection and levies and so forth. So it's best to behave once you're on it. Now, this is the form that you file. You can mail the form in by itself. You can see there's a place that you can sign, and you can also file it with the tax return electronically. Either way works. You can make payments on your installment agreement in a variety of different ways, including check, money order, credit card, debit card, the electronic federal tax payment system. You can even do it through payroll deduction at work. Well, believe me, if you've got a paycheck and you're defaulting on your taxes, the IRS will come along and do that payroll deduction for you, whether you want it or not. But you can do it that way, voluntarily. Now, setting up an installment plan is not free. There is a charge associated with it. If you set up the payment plan and you want to make payment by check, money order, or credit card, the application fee is $105. If you want to do it by electronic funds withdrawal, where you give them direct debit information for your financial institution and they take the money out for you each month, the fee is less than half, only $52. And if you want to do it through payroll deduction, then it would be back up to $105. Now, some taxpayers will qualify for a reduced fee if their income is below a certain level, and if you qualify, the IRS will automatically, in most cases, charge you the lower fee, which is $43. But if the IRS does not say that you qualify, you can apply for a reduced user fee by filing Form 13844. I checked that form out, and it essentially says you have to be poor. So if you're poor, then you can get the reduced rate. Now, online payment agreement system or agreement application, this is another method of setting up. It's a little bit different than an installment agreement, and essentially what happens is you file your return and you find out, well, obviously when you file it, you know you don't have the money to pay. But you might have it in a few months or a few weeks. You don't really need or want to set up the 9465 installment agreement because you're going to have the money sooner than that. That's not what your option is. So I once had a client who owed $50,000 worth of tax return. She didn't have it today, but she's going to have it within the next 4 months. So this was the option that she went for. And essentially, you file the return, you wait for the system to register that you owe money, and then you log in and provide information about how you want to go about making your payment. And this is the URL that you can go to for that. There's also something else called a partial payment installment agreement. And this particular option became available on January 17, 2005 as a result of the passage of the American Jobs Creation Act. And essentially what this allows for is a person to say, I can't afford an installment agreement. I don't have the money. I don't have it, and I have no prayer of having it. And we've been in an economic time within the last 4 years where there's a lot of people like this. For a particularly high impacted area is real estate agents. People who have been making their life in real estate and doing very well at real estate for decades are all of a sudden practically destitute and under great hardship. And so in at least 2 situations with real estate agents, I have made this particular application. And what happens under the application is you essentially tell the IRS the income is practically nothing. They aren't making enough money to live on, let alone set up an installment agreement. It's not going to happen. And what you do is you actually have to submit an application, and the application is done with Form 433A or 433B, depending on whether you are an employee or self-employed. It's essentially a financial disclosure statement. You're showing how much money you have in pension plans, how much your assets are worth, how much all of your debts are worth, how much it costs you to live day to day. And then the IRS looks at all of that to establish whether or not you can, in fact, afford to pay them money. If you can afford to pay them something, they're going to want that. if you can't afford to pay them anything, and it's obvious you're not going to have anything for quite a while, they can actually put you into something called uncollectible status. While you're in uncollectible status, they can still put liens on your assets. They'll still be showing on credit agency reports that you have a lien, but they're not going to be harassing you. They're not going to be sending collection agents after you. They're just going to leave you alone, and the interest will continue to accrue. Now, under that particular system, they will review your account every 2 years, and every 2 years you're going to have to resubmit the application. But if you continue to be destitute, you're going to continue to get this relief. And it happens to be one of the IRS agents that I worked with on setting up one of these, who recommended that I do it for my clients, said, you know, if it stays in this uncollectible status for more than 10 years, it's erased. Well, there's the question in the class, does the statute of limitations run out eventually? And the answer is yes, at the 10-year point. If you're in uncollectible status on a particular year for over 10 years, essentially it becomes uncollectible permanently. It's erased. It's also erased if you die. The IRS does not collect taxes owed by people who've died in situations like that. All right, it is possible that the IRS, in looking at your financial situation, will establish that you have assets that you could sell, and if you sold those assets, you'd be able to pay them off. If they determine that, then you might have to do that. On the other hand, if they see that you have assets, but the sale of the assets will cause hardship or prevent you from making a living, they will not require it. Now I'm going to talk about something else. It's called innocent spouse relief. Occasionally it happens that in an earlier year, a married couple files a joint return. And subsequent to that, the IRS examines the return and establishes that taxes were underpaid, or it may be that the IRS doesn't even examine the return. It's just that when the return was filed, taxes were owed and not paid. But we essentially have a situation where a tax return was filed, it was a joint return, money was owed, and it hasn't been paid, or the return was adjusted by IRS and taxes were assessed and now this money is owed and has not been paid. And it is entirely possible, and not that uncommon, that in a situation where a joint return was filed, that one spouse is responsible for most or all of the tax owed. But the IRS doesn't care about that. When a joint return is filed, we get into something called joint and several liability. And the IRS says that under joint and several liability, the fact that you signed that return means you've agreed to all of the tax responsibility on that return. And we don't care who or why the money on the return is owed. What we care about is you agreed to be liable for that. So what happens if things go sour in the marriage? Or what happens if the tax return that was filed did not report income? You're a spouse, you've just signed the return. To your knowledge, it's truthful and accurate, but you were not aware that your spouse had failed to report income on there. And then subsequent to that, the IRS comes along and adjusts the return and starts coming after you for the money. Is there anything that you can do about that? And the answer is yes. There's something called innocent spouse relief. And there are 3 types of relief that are available to married persons who file joint returns. The first one is innocent spouse relief. The second is separation of liability relief. And the third one is equitable relief. The one that I have direct experience with is innocent spouse relief. I haven't done it in years. The last time I did it actually was before they even had a form for it. It used to be that you have to type a letter and explain the situation. And in more recent times they came out with the form. But I'll give you an example of one of the situations I dealt with successfully. I had a client married to a fisherman. They had children together. They lived together for a number of years. She was a school teacher. He just abandoned her. Abandoned her and the kids. She had not seen him in many, many years. And all of a sudden she got a letter from the IRS saying that she owed all of these taxes on fishing income he'd had that had never been reported on their joint return, and they were after her for several $1,000s. Well, that was a perfect example. She had no knowledge that he'd left fishing income off. She didn't know anything about taxes. He'd brought a tax return to her and said, sign it, and she did. Years later, IRS is after her for the money. So that was an example of where innocent spouse relief was something that she qualified for, and we filed for, and she received it. The IRS made that go away and focused their energies on the fisherman husband, whatever happened to him. So here is the innocent spouse relief form. I'm going out of my way to really tie innocent spouse relief and injured spouse relief into the same class because I have observed with my own staff that people get confused about the differences between these two types of relief. Injured spouse is filed to protect my refund on a current year return that is being garnished to pay a debt owed by my spouse that is not my debt. Innocent spouse is filed when I'm no longer talking about the current year return. I'm talking about something that happened in the past, a return I filed a while ago. And IRS has come along and said, I'm responsible for the debt on that prior year return. Nothing to do with what I'm doing today, whether I'm married today, whether I owe any other debts of my own, or whether the joint return I'm filing has debts of my husband. It has nothing to do with the current year return. It has everything to do with the past. So 85857 is another multi-page form. It has questionnaires built in, essentially asking things like, are you still married? If you're not married, how long have you been separated? When was the last time you saw this person? Do you have a divorce decree? If you have a divorce decree, give us a full copy of it. They want to figure out what's happening in that relationship. It also asks questions to establish if you knew about the debt or should have known about the debt, whether you benefited from the money that created the debt, things of that sort. Now, there is a notice that came out in 2012-8 notice. The IRS has announced that it will use proposed new procedures that will expand how the IRS will take into account abuse and financial control by the non-requesting spouse in determining whether equitable relief is warranted. Innocent spouse filing may now be granted in cases where a taxpayer signed a joint return but did so because they were abused or lacked financial control. So it's just a new procedure that they have in place. And I've already explained the difference between innocent spouse and injured spouse. Let's move on to the next topic, which is estimated taxes. The law imposes penalties and interest on filers who pay their taxes late. While it is possible to pay your taxes at a time that you file your return, it's April 15th, I owe $5,000, I'm just going to write a check, send it in the mail. You can do that. You can be penalized if you owe more than a certain amount when you file. In most cases, you must make estimated tax payments for 2011 if you expect to owe at least $1,000 for 2011 after subtracting your withholdings and credits, and you expect your withholding and credits to be less than the smaller of 90% of the tax shown on your 2011 return or 100% of the tax shown on your 2010 return. And if your AGI is more than $150,000, then you have to pay in 110% of your 2010 tax after credits. So who is required to pay estimated tax? Well, the estimated tax rules apply to people who are U.S. citizens and resident aliens, as well as residents of Puerto Rico, the Virgin Islands, Guam, the Commonwealth of the Northern Mariana Islands, American Samoa, and non-resident aliens who must file using Form 1040 ESNR. There is an exception. You do not have to pay 2011 estimated tax if you are a U.S. citizen or resident alien for all of 2010 and you had no tax liability for the full 12-month period of 2010. So in other words, when you filed or could have filed your 2010 return, it would have had zero tax liability. If you can show that that is you, then you don't have to make estimates in 2011 regardless of how much you earn, because of course the minimum pay-in amount is 100% of last year's tax, and if last year's tax is zero, 100% of zero is still zero. Now, what about withholdings? If you are an employee, you may be able to avoid having to pay estimated taxes by having your employer withhold income taxes from your pay. Even if you do not have taxes withheld evenly throughout the year, you can avoid the penalty for underpayment of tax by having the minimum amount withheld by the end of the year. So here's an illustration of what I mean by that. Sam works for ABC Company. During the year, he was short on cash, and so he went to his employer and said, hey, employer, please stop withholding. I want to go to zero withholding. I need some extra cash right now. And so the employer is not supposed to do that, but, well, they do it anyway. They stop withholding. And then later in the year, around October, Sam says, okay, financially things have improved. Please start doing withholding, and ooh, I have some catch-up to do. So please hold more. Between now and the end of the year, I want you to do all the catch-up. And at the end of the year, he gets to that point where he is completely caught up on all of his taxes. He's even. He's fine. It doesn't matter that the withholding was not even. Now, when you're paying estimated taxes quarterly, where you're writing that check and mailing it in with your 1040 ES voucher, you need to be paying those quarterly unless you can show your income was not equal. But for wages, you could have completely equal income throughout the year. You could even be top-heavy at the beginning of the year and have more wage at the beginning of the year than you do at the end. All the IRS cares about is how much withholding is showing on that W-2. So for a small business owner who has control over their payroll, perhaps an owner in an S corporation, that S corporation owner could really go the first 10 months of the year having zero income tax withheld, and then issue them a year-end bonus payroll check that does all of the withholding at one time, and technically they could get away with that without having to pay any penalties. So that is some kind of control. Now there are some special rules about estimated taxes for farmers and fishermen. If at least 2/3 of your gross income is from farming or fishing, you may do one of the following. You do not have to pay estimated tax if you file your 2011 tax return and pay all the tax due with the return by March 1st of 2012. So that's kind of a nice one. You don't have to pay anything in it at all in the year before if you're a farmer or fisherman. And if you get in and get all of your tax return done and filed and paid by March 1st, you're good to go. Also, you do not have to pay estimated tax if you expect your 2011 income tax withholding to be at least 66 2/3 of the total tax to be shown on your 2011 return, or 100% of the tax shown on your 2010 return. If you must pay estimated tax, you're required to make only one estimated payment by January 17, using special rules to figure that amount. So farmers could avoid all of the estimated tax payments except the final one. They need to make that timely. What are the due dates for estimated taxes? Well, these are kind of tricky. They're not intuitive. The first one is April 15th, which is 15 days after the end of the third month. The third month being, of course, the end of the first quarter. So it makes sense. But the second payment is due only 2 months later on June 15th. So the second quarter, well, it isn't really a quarter. It's 2 months. And then the third quarter, well, it is 3 months after the end of the second quarter, but it's not 9 months into the year either. And then, of course, we do have a 4-month break between the end of the third quarter and the end of the fourth quarter. And the fourth quarter is January 17th, 2012. Now, if the due date for the estimated tax payment falls on a weekend or holiday, of course, we go to the next business day after that. What happens if I forgot how much estimated tax I paid? Well, this happens quite often, actually, especially when I have little old ladies for my clients. They don't remember exactly what they paid, what checkbook they used, when they paid. And they come in with their tax papers and they say they paid their quarterlies and they don't know what or when or how. And it creates a problem because if my client tells me that she made 3 payments of $250 during the year and I put $750 down as estimated taxes and she actually paid more or less than that, then she's going to get a letter from the government saying that the tax return was wrong. And all she's going to know is that the tax return was wrong. She's not going to understand or comprehend the reason for it. She's just going to get a letter saying the tax return is wrong, and she's going to freak out and call me. So I don't like not being precise with these things, and I certainly don't like phone calls in July from little old ladies who say I did their tax return wrong because they have a letter from the IRS saying it was wrong. So what I tend to do when I have a client who is not absolutely sure of their payments and the amounts and the dates and can't show me canceled checks or ledgers where they recorded it, I call the IRS while they're sitting at my desk and get the IRS while I'm sitting with her to tell me the amounts and the dates. And I use those and enter them on the return. Now here's the number to call. There's actually a tax practitioner hotline, which is better than this number. I could give that to you, but I don't have it right with me right now. Janice, in our example, is 70 years old, and during the year she made the following estimated tax payments. On January 5th, 2011, she sent in $500. On April 10th, $550, on June 15th, $550, on September 6th, $550, and then on January 10, 2012, she sent in another $550. Well, let's take a look at these 2 January payments, because this January payment up here, that has nothing to do with the 2011 estimated tax payments. That's a 2010 estimated tax payment. So if you're holding a check written in January of 2011, you should not be applying that to the 2011 return. It belonged on the prior year return. And the deal is your client's going to come in with all the canceled checks from 2011, but they're not going to bring in the one from 2012 because we're not doing our 2012 return. This is the logic in their mind. So as the preparer, you should be looking at the dates on those checks. And if your client brought you a January 11 check and didn't bring you a January 12 check, be looking for the January 12 check. The other issue is that when you itemize deductions, because Janice is allowed to claim an itemized deduction for the taxes she paid, she'll be able to claim an itemized deduction on Schedule A only for those taxes paid during the year. So she'd be able to claim an itemized deduction for the January 11 payment through the September 11 payment, but she won't be able to claim an itemized deduction for the 12 payment until she's preparing her 12 return. So in essence, these January payments get split between years, with the estimated tax amount being applied to the earlier year, but the itemized deduction being applied to the year in which the payment was made. Now, let's suppose you underpaid your estimated tax and you have to pay a penalty. Let's figure the amount of estimated tax to pay. And for those of you who are online, one of our attendees, Len USA, says the tax practitioner hotline number is 1-866-860-4259. You should see that in the chat field there. And Mickey repeated it. Thank you, Mickey. All right. The tax practitioner hotline gets you through to someone who is more knowledgeable than the 1040 number. If you call 1-800-829-1040, I used to do that when I was new to the business as an early young tax practitioner. And I quickly found out that I got people on the other end of the phone who were reading to me from Pub 17. And I said, you know, by the time I called you, I'd already read that. My question goes beyond Pub 17. So I just sat on hold for an hour and a half to have someone read to me from Pub 17. Okay, well, a few years ago, over a decade ago, they did come out with this tax practitioner hotline. And when you call it, you get people who are a little bit better trained. But you still have to be on your toes because they are reading from something. They're actually not allowed to ever tell you anything that they're not reading. They can't ever, because they know something, just tell you what they know. And how do I know that? Well, my basic tax course, last year I had an IRS guy take it. And this is what he told me. He took the course, he said he took the course because he wanted to actually learn tax law. That he'd been one of those telephone answer people for a number of years, and they go through training programs at IRS to teach them how to look stuff up. But they're not actually ever allowed to say anything from memory. Everything they ever answer to you on the phone has to be something that they're reading off their computer screen. He really wanted to know how to all tied together, so he took our course. This is what he told me. Yes, that is true. There's a person in the classroom commenting that she's observed that this tax practitioner line seems to have specialists and that they'll end up transferring you to the department that can answer the question. And I've observed that. When I call and I have a tax question, let's just say this year I had a really complicated tax question. I was figuring a client who had received it was a K1 off of a publicly traded partnership, and they had sold stock in that partnership, or actually units per se in that partnership, and we needed to be recovering the gains on certain depreciation items that had been claimed by that partnership over time. And although this is something that I should have paid attention to over the years, suddenly it was just occurring to me, oh my gosh, I need to be filing a 4797. I have to reduce their capital gain amount on schedule. I have to increase the cap. I have to do something on Schedule D. And my mind was just starting to cement all of this together. So then I tried to make my software do it, and my software couldn't do it. Couldn't even begin to deal with the complexity of this tax situation. The partnership had issued a worksheet with all the things I should do, and I was figuring it all manually, but there was no way I could make my software do it. It was incapable of it. I had to do all of these overrides to even get it to start to work, and I wanted to be really sure about what I was doing before I complained to the software company by calling the IRS. So I called the IRS, and I got put through to 2 or 3 different people, and they finally said, we do not know what to tell you. We're going to have to turn you over to one of our auditors. And they actually have people who are auditors who sometimes when they're not in the business of auditing get to answer questions. And so I talked to one of those. And so I was explaining to her all of the things I thought I needed to do, but I couldn't find it anywhere in writing, and I just wanted to be sure about what I was doing from what publication. And she said she didn't know, but she would look it up and call me back, and she did. And I said, okay, great, that's what I thought, but where is it in writing? Because I don't ever like to do anything that I haven't read. And it turned out all of the procedures I needed were split up between about 3 different publications and form instructions. But we finally had 1 paragraph in this publication, 1 paragraph on this form instruction, it all pulled together. So I will update my class when I get to partnerships to include this information, because I think it's important and useful. At any rate, the tax practitioner hotline is there, and it provides useful information. The wait time is increasing. It used to be seconds, and now it's 10, 15, 20 minutes sometimes that I'm on hold. But you just put it on speakerphone and work on the tax return while you're waiting for them to come online, and at some point they'll come on. All right, figuring the amount of estimated tax to pay. The IRS does have a worksheet that you can use to figure out the amount of estimated tax you pay, but quite frankly, I think the worksheet, well, to put it bluntly, sucks. I don't like it. And here's why. The worksheet does nothing to account for differences in the current year over the past. It simply looks at the past year, how much you owe, how much you had withheld, how much income you had, and figures out what your estimated tax is based on that last year. But it doesn't account for any changes that will be coming in the future, or how this year might be different than last year, how other things can happen. So I don't really like to use the worksheet even though it's there. So this is the system I use for figuring out how much estimated tax a person needs to pay. Firstly, you figure your approximate income and deductions for the year coming, the year to which I want to start making estimated tax payments. Then you calculate the expected tax liability for the coming year after projecting income and deductions for that year. Then you subtract the amount of tax you expect to have withheld from your pay by the end of the year, and the difference between your anticipated tax and the amount of anticipated withholding is going to be the amount you're going to owe when you file next year. And whatever amount that is, divide it by 4. Now you've got your quarterly amounts. So that's essentially what I'll do. I'll be sitting there with my client. My client says to me, well, I'm expecting a big sale. I have a piece of land. I'm going to sell it. I think my profit's going to be $100,000. How much tax do I need to pay as estimated tax when that happens? So I'll just figure their tax return with that change, let my software figure out what the tax is going to be, and tell them, well, this is the difference. You can pay it in quarters, or you can pay it in the quarter where you make the sale.
Password number 2 is Aragorn, A-R-A-G-O-R-N.
How do you make estimated tax payments? Well, there are 5 different ways to do it. One is to credit an overpayment. So your 2011 tax return shows a refund. You can have that refund applied towards estimated taxes for the coming year. The other is to mail in Form 1040-ES, like the one you see here, with money. The next is to pay electronically using EFTPS. The next one is to do electronic funds withdrawal from your account, and the 5th way is, of course, to pay by credit card. If you pay by credit card, they will charge you a fee. Penalty for underpayment of estimated tax. If you don't pay your estimated taxes on time, are you going to have to pay a penalty? Yes, a substantial penalty. Really, it is. 5% of the amount over $1,000, or 5% of the amount you should have paid over the amount that you should have paid but didn't pay. So firstly, you look at 90% of the tax shown on your 2011 return, or 100% of the tax shown on the earlier year return, 110% if your income is over 150. And you compare that amount, those two numbers, with the amount of tax shown on this year's return. If you can show the withholding on your current year return is 90% of the tax shown on the current year return, you don't owe a penalty. Or if you can show that the withholding on the current year return is 100% of the tax on the prior year return, you won't owe a penalty, regardless of how much you owe. So we're always looking, if I go back up to page 2 of our manual, at what we're concerned with estimated tax penalties. We're looking at the number on this line, line 61. What was on line 61 for 2010? And what's on line 62 this year? Is 62 more than the amount shown on line 61 of last year's return? If it is, I shouldn't have an estimated tax penalty, regardless of how much I owe this year. If my income this year is over $150,000, then I need to be able to show that the number on line 62 of this year's return is 110% of the number on last year's return. If I can show that, then I don't owe an estimated tax penalty. The other option is to look at the tax shown on this year's return. So now I'm looking at line 61 for this year, and if I can show that line 62 is at least 90% of 61, I'm good, and I don't owe a penalty. But if I can't show that line 62 is at least 100% of last year's line 61 or 90% of this year's line 61, then I owe a penalty. And how much is the penalty? Well, it's 5% of that difference. That is over $1,000. Now, the estimated tax payments are supposed to be made equally in quarters. And if you don't make your payments in quarters, just going, that's weird. I'm back in deja vu land. I have to go back to where I left off, page 44. If you're not making your estimated tax payments quarterly like you're supposed to, then you fill out Form 2210 to calculate the amount of your penalty. Now, my tax software will automatically throw a penalty on the line, whether I'm paying attention to it and want it done or not. So I have to make deliberate procedural moves on my tax software to prevent it from calculating the penalty. One of those procedural efforts is to enter last year's tax liability in there, or last year's taxable income. That's what it wants to know. It wants to know last year's taxable income, and if I tell it that, it will use that information to establish whether or not a penalty is due. And if one is due, it calculates it and sticks it on the form. But it doesn't give any regard to about differences in income or that my income might have been unequal throughout the year. If I want to try and reduce the amount of the penalty, one of the options is to just eliminate it and let the IRS figure it for them. But it's likely the case IRS will figure the same amount my computer just did. But if I feel my client is going to qualify for an exception to the penalty, then I should be applying for that exception and attaching the correct documentation. And I do that with Form 2210. And the starting point on Form 2210 is, do I need to file the form? And if I believe that I'm not subject to a penalty, I can file for a waiver by checking the waiver box. But the next pages of the form, and I would just to explain what a waiver is, you can request a waiver for some or all of the penalty if you can show the IRS that the underpayment was due to a casualty, disaster, or other unusual circumstances, and it simply would not be fair to impose the penalty. Or in 2010 or 11, you retired after age 62 or became disabled and your underpayment was due to reasonable cause. To request the waiver, complete Form 2210, check box A or B in Part 2. If you checked box A, complete only page 1, and if you checked box B, write the amount you want waived in parentheses. Attach statements to explain your reasoning. Now, most people aren't going to qualify for either of those exceptions, but they might qualify for income averaging, or income averaging is the wrong word to use, to be able to show that their income was unequal throughout the year. And to do that, you fill out this Section A right here. And Section A says, what are the required installments and how much did you pay over time? And it does some math to figure out the penalty. But then on the next page, Section AI, or Schedule AI, annualized income, this is where you can tell the IRS how your income was uneven throughout the year and why you didn't have to make estimated tax payments evenly because your income wasn't even. So it asks you to enter your adjusted gross income as of the end of March, your adjusted gross income as of the end of May, your AGI as of the end of August, and your AGI as of the end of the year. And it asks you to do all of those same things with the credits and deduction items that you have. And then it compares all of that to the actual payments that you made during the year. So by doing that, and I've done it many times over the years, I can sometimes reduce a penalty from several $100s to less than $100. It is a useful endeavor. Now, for those of you who are online, I'm going to have you work on a classwork assignment. I'm hoping I can give you at least 10 minutes to whittle away at it. And the classwork assignment is at the end of your manual, and it appears beginning on page 60. Now, given that we probably won't have a lot of time for you to work on the assignment during class, if you could please use the break period that we're on right now to acquire copies of these forms, 1040, 1040X, 8812, and 8863. You could also read through the problem while we're on break to be familiar with it so that when I do say it's time to start your classwork, you're ready to go. And this is just a brief point in time where I realized nowhere in my series had I really talked about Form 8821, and IRS says they're going to test on 8821, so I'd better tell you about it. 8821 is a tax information authorization release form. When a taxpayer signs this form, they are giving the IRS permission to talk to the individual or firm labeled or named on the form. It is not a power of attorney. It does not allow you to represent your client before the IRS, but it does allow you to receive information from the IRS pertaining to a taxpayer's tax return. There is another form, a power of attorney form, that you would need to use if you actually want to be able to represent your client. And now we're on to the next topic of the day, which is amended returns. And oddly enough, isn't that what we called this course, amended returns in the kitty tax? And we're saving those to the very end. Well, we're finally there at the title of our course. Makes me think of a record album. You know, you buy the record album to get one song, and it's the last song on the album. But it's the name of the album. All right, so the name of our course is Amended Returns, and here it is. So if you made an error on a back year tax return, or even a current year tax form that you just filed, is it the end of the world? Well, it depends, of course, on the extent of the error, but it is correctable. Now, what I can tell you as a managing tax practitioner, where I'm supervising the work of tax preparers, there just seems to be this universal tendency on the part of tax preparers that has been my experience supervising, and I've been supervising tax preparers for 20 years, literally hundreds of them over the past 20 years. There seems to be one mode of thought, and that is, if I check amended return, my computer will amend the return. And most software has this fillable function. It says, do you want me to autofill? And you check yes, and it fills out this form, the 1040X form. And you go, great, it's amended. I'm done. Unfortunately, it is not that simple. You really have to understand what it is that the computer is trying to do. Now, in the system that we use, which is Drake software, Drake autofills the 1040X screen with whatever is currently entered as a tax return. That means if the return that I'm amending, the original return prior to amendment is there currently in the screen as it was filed, if I push autofill, it will fill what was on the original return right then and there. But if I've made any changes at all to the return so that it is now different than what was filed with the IRS, and then I click autofill, it's going to be wrong. So there has to be a deliberate methodology to whether or not you allow your computer screen to autofill for you or not. And again, as I've said, so many tax preparers seem to think I've clicked amend the return, my computer has filled the form out, and I'm done. But it doesn't work that way. And the only way to teach you how it really should work is to walk you through the mechanics of actually completing Form 1040X so that you can see the steps that are necessary. So let's first look at the procedures of who and how and what you can file an amended return. Firstly, you cannot electronically file an amended return at this time. The IRS has implemented a new modernized system of electronic filing called MEF, M-E-F, or Modernized E-File. And once fully implemented, MEF will allow for electronic filing of amended returns. But that day is not today. As we sit here right now, amended tax returns at the individual level have to be filed paper. Modernized E-File does allow for current year electronic filing of amended 1065 and 1120S returns. So if you are amending a corporate or partnership return, it is possible to e-file those electronically, and I have done it nicely, thank you. But we're talking about 1040 returns today. Now, if you file an amended federal return, in all likelihood, you are in a situation where you probably also need to amend your state tax return. And very often the reason an amendment occurs at the federal level is the IRS has issued a CP 2000 letter to a client saying, hey, you left stuff off your tax return. We want you to pay tax on it. So the client comes in and says, yeah, I did leave this off. Can you amend my return for me? And sometimes they'll say, well, the IRS letter, what they're giving you, is accurate. You do owe the money. No point in arguing. We could amend, but it's not going to change anything. You may as well just pay the money and accept it. But just in saying those words, I also have to realize, well, this has an impact on the state return. So although it's really not necessary to amend the federal return, the fact that the federal has made an adjustment to the original return means that the IRS is now going to send a letter to my state and notify my state of the change, and my state's going to be looking for the money. And my state can ask for that money from anywhere from now until 4 years from now, so I may as well get it over with now. So at the state level, you have to be aware of it. And at the federal level, it could be that you've received the CP 2000 letter, but you don't agree with it, at least in part. And so you're going to file an amended return to accept some or none of their changes, but maybe you want to tell them other things. Or another reason for filing an amended return is you just discover, hey, I got an extra W-2 in the mail after I filed. Or I was having a conversation with my tax preparer, and during that conversation, my preparer told me I can claim my sister as a dependent, and I didn't know that, and I didn't claim her last year. Maybe we could go back and amend last year and get that. So we're going to do that. So when do you file Form 1040-X? You file 1040-X only after you have filed your original return. And generally, you have to file for a refund or credit within 3 years, including extensions, after the date you filed your original return, or within 2 years after the date you paid your tax, whichever is later. A return filed early is considered filed on the due date, generally April 15th. However, if you had an extension of time to file, for example, until October 15, but you filed earlier than that, your return is considered filed on this earlier filed date. So if you didn't file by April 15th, so you filed for an extension until October 15th, and then you filed on August 30th, the date that you filed would be August 30th. That's when the statute of limitations begins. Now let's suppose you file late. Let's suppose you didn't have an extension, or even if you did, you file late, maybe 2 years late. Can I get a refund? Well, the answer is you can file for a refund up to 3 years after the due date of the original return, or 2 years after you pay tax. So let's just suppose I filed 2 years late, and at that time I owe, so I pay tax. 1 year later, the statute of limitation expires on the original due date of the return. But because I paid tax on that date, I have 2 years to file for a refund to claim a refund of the tax I paid on that date. That's what it means. So let's look at the procedures for filing a federal Form 1040-X. You should correct your return if after you have filed it you find that you did not report some income, you claimed deductions or credits that you should not have claimed, you did not claim deductions or credits you should have claimed, or you should have claimed a different filing status. But remember, generally, once you have claimed the filing status married filing joint, you cannot later change to married filing separate. And here is the 1040-X form. You will see that the 1040-X form has 3 columns. Now, for all of the history that I've been in taxes, the 1040-X fairly much looked like this, and then IRS had a spasm. And for about a 2 or 3 year period, they changed the 1040-X. Oddly enough, they made the new 1040-X look a lot like the 40-X we have here in the state of Oregon. And the 1040-X that the IRS changed to was simply, what was the tax on the original return? What's the tax on the new return? Pay us the difference or we'll refund the difference. And that was really the only information that it was asking for other than an explanation. But apparently that didn't go over so well. It's simpler than this form, the one that we have back again, but obviously it didn't work for them, so they went back to this version. And this version is saying, okay, we've got 3 columns. Column A is the original amount, column B is the change, and C is the correct amount. Well, how am I going to get the original amount? For the original amount, I'm going to look at the return that was originally filed or the most current revision of that filed return. Sometimes you can file a return and then amend it, and then you're amending it again. So you're going to look at whatever version of the tax return is currently in IRS coffers. That's the one that you're going to use. And you enter the numbers from that original return. What was my adjusted gross income on that original return? What were the itemized deductions I claimed on that original return? What were the exemptions that I claimed on that original return? And what was my taxable income on that original return? Then I need to look on the original return to get my tax, any credits, any other taxes. And then down here under payments, I need to enter my original federal tax withholdings on my original return. Any estimated tax payments showing on the original return, any earned income credits showing on the original return, and any other refundable credits, check the box that applies for the refundable credit at issue. Then I go through and do all of those same entries for the current year revised return. So the one that I'm revising, what is the numbers on the new return? And I enter those in column C. And then I look at the difference between column A and column C, and I enter that difference in the middle column. Now, in order to fill out this form, you obviously have to have the original return prepared and sitting next to you, and you have to have the amended return all prepared and sitting next to you. You can't fill out 1040-X until both those things are done. So moving on to the next page, Part 1 on page 2 has to do with changes in the number of exemptions. How many exemptions did you claim on the original return? How many exemptions are you now claiming on the corrected return? And if you are adding a dependent on the new return that was not on the original return, what is their name, social security number, relationship, and are they a qualifying child for the child tax credit? Also, they give you a place in Part 2 to specify whether or not you want to now check the presidential election campaign box, but in the past you did not. And then underneath that, an explanation of the changes and a place to sign. The IRS wants you to sign the 1040X. You do not need to sign the corrected 1040 that is assembled underneath it. Preparing your amended return. Again, as I said, you have to attach all of the, you take the 1040X and you put it on top. Underneath it, you'll put the 1040, and then underneath that, you'll put all of the changed schedules that are a part of the corrected return. If you have a refund, you'll hope that the IRS is going to send it to you. If you're within the statute of limitations and they accept the amendment, they should mail it to you. And it can take up to 3 months to be processed. Now, IRS in its instructions says it can be up to 3 months. My experience in the real world is it's anywhere from a month to 5 months. When things are going real smoothly, I can have a client receive a refund lightning speed, very much faster than I would ever have imagined. And in the worst of situations, it takes ages and ages and ages. Balance due. If you owe additional tax with your return, pay the balance due with the amended return. Now, because you're owing money on an amended return, and presumably you're filing that amended return after the due date of the return, you're probably going to owe some interest and penalties for the extra amounts owed. And you can, as a tax preparer, laboriously go through figuring out what all those penalties are, figuring them out and having your client pay them. Or you can just mail the amount that is showing on the face of the return as a balance due and let IRS figure the penalties and interest and send them a notice. And that's pretty much what I recommend. So it's now time to do that classwork assignment I was telling you all that I'd like you to do. Let's go take a look at it. So Mary Poppins needs to amend her 2011 federal tax return. She did not claim her younger sister Laura as a dependent on her original return, and during the year Mary provided more than half the support for her sister. And this is Laura Poppins' social security number and her date of birth. And Laura lived with her all year while she was attending college. Laura paid $2,000 for tuition and fees expenses that she incurred while in her third year of full-time studies. Mary's original return also failed to include income from a second job that she worked at for part of the year. Mary has the following additional W-2 income to report, and a copy of the original filed tax return is included next in this manual for reference in preparing Mary's amended tax return. And here is Mary's W-2. You can see she earned $3,500. She had $600 of withholding. She did not include this income on her original return, nor the withholding on her original return, so we're going to amend it for that reason. So for you as students, your job is to prepare the corrected return. And I can see in the time we have allowed, you probably don't have time to prepare the whole corrected return, so I'm going to show you the corrected return. And I'm going to show you the original return, and your job then would be to do the 1040X. How's that? So her original return, we're showing that she had one dependent, Jane, and that her wage was $36,100, and that Jane is her daughter and is eligible for the child tax credit, 2 exemptions being claimed. We move over to page 2 of the return, and we have that adjusted gross income of being $36,100. So the information that you're seeing on this original return needs to be put on the 1040X form in column A. We can also see the amount of tax that was assessed for Mary on line 46, and we can see credits. She has an education credit of $240 and a child tax credit. Well, this education credit is a credit that Mary claimed for herself. Now she's going to be claiming an additional education credit for her sister, Laura. And we have a child tax credit that Mary claimed for her daughter in the amount of $1,000. We can show her net tax after credits was $1,186. The withholding on the original return was $1,500. The American Opportunity Credit, the refundable portion of it, was $160, and she had a $474 refund. Moving down the return, we see the education credit form, and you can see that the only person listed on this education credit form is Mary. So that's the original return. Let's compare that to the corrected return for Mary. So in amending Mary's return, the first thing we have to do is figure out what the new return looks like. So in the first illustration I gave you, we're looking at all of the numbers that need to go in the column A of 1040X, and all of the numbers that belong in column B of 1040X are now up on the screen in front of you. In a perfect world, I would make you prepare the amended return from scratch, but we don't have time for that, so I'm just going to have you fill out the 1040X. So here we have a second dependent being added named Laura. The number of exemptions has increased to 3. So that means I need to fill out page 2 of 1040X to enter these changes in dependency. The income has gone up because I had that extra W-2, so the income is now $39,600. I go over to page 2, and now I am claiming an extra exemption on line 42. That amount has gone up. I've got extra tax showing. I've got education credit that has gone up. I've got a child tax credit that has gone down. And the reason the child tax credit went down is my tax ended up being 0 down here. And my withholding has gone up. Now I have an additional child tax credit showing on line 65, and the amount of my American Opportunity Credit has gone up.
It is now time to push pause on video playback and complete the Session 22 classwork assignment involving an amended return for Mary Poppins. When you are finished preparing Mary's tax return, her amended tax return, resume video playback for a review of the answer key.
What is the refund that's due on the amended return? Did anyone get that far? That's actually the really simple calculation, but I'm curious to see if any of you figured out what the refund that is that's due with the amended return. Todd, 2630, thank you. And the math for 2630 couldn't be easier. If I take these two forms and line them up again here, as you see, you can see that on the amended return, we have a refund of 3104, and on the original return, we had a refund of 474. If we subtract 474 from the original return out of the 3104 on the amended return, that's the amount of refund we should have on the 1040X when we're done. It's the most logical thing in the world, right? So let's just go back up now and take a look at the 1040X form. And taking it piece by piece, the first thing that you're supposed to do is check that what year this form applies to. And it applies to 2011, so we've checked that box. We've also checked that the filing status is head of household. And then we enter in column A the income shown on the original return. The adjusted gross income on the original return was $36,100. The missing W-2 is $3,500. So the new adjusted gross income is $39,600. Filing status, the standard deduction is the same both times. So the middle column is blank, but on either side we're balanced at $8,500. Then we move down and we say, what is income after we subtract the standard deduction? And on the original return, that is $27,600. On the corrected return, it's $31,100. And the difference is, again, that W-2. Next, we figure the exemptions. The number of exemptions on the original return was 2. And so we take 2 times 3,700, and we get 7,400 on that original return. On the corrected return, it's now 3. And each exemption is worth $3,700, so the corrected return is showing $11,100, and the middle column is showing the difference, $3,700. Now, oddly enough, the taxable income is actually lower. She left off $3,500 of income from that W-2, but after we account for the exemption she's getting for her sister, Laura, we find that her income is actually down by $200, her taxable income. Next, we look at the tables. We go to the tax tables and look up the tax. Well, I didn't make you do that. I just told you what the tax was by giving you copies of both tax returns. The original return showed tax of $24.26. The amended return showed tax of $23.96, and the difference is $30. The credits on the original return were $1,240. On the corrected return, they're $23.96, and the difference is $11.56. Now we go through and subtract the tax credits from the tax. And on the original return, we were left with tax of $1,186, but on the corrected return, the tax has dropped to 0. So there's 0 tax showing on the corrected return. And of course, the difference between 0 and $1,186 is, well, $1,186. The next step is to look at the federal withholding, and on the original return, it shows $1,500. On the corrected return, $2,100. The difference is $600. We then go and say, what kind of refundable credits are being reported on the amended return? And we had an 8812 and we have an 8863 for which we are claiming refundable credits. The amount of refundable credit shown on the original return was $160. The amount of refundable credit shown on the corrected return is $1,004, and the difference between those two numbers is $844. The overpayment that was shown on the original return is $474. The amount of overpayment that is shown on the corrected return is $3104. You subtract $474 from $3104 and we have the refund. But when we already knew that before we even started filling out the 1040X, right? All right, so then we move on to page 2 of the form, and we had to change an exemption. So it's necessary to fill out page 2. And we start by how many exemptions were we claiming for Mary on the original return. She had one exemption for herself on her original return, and that's the same exemption she's claiming on the corrected return. She had a dependent child living with her on her original return, same dependent child on the corrected return. So there's no change here. But now she is adding an other dependent. And the other dependent is her sister Laura. And so we're going to enter a 1 in the corrected column for the corrected return. Since there was no other dependent on the original return, the difference is 1 dependent. And then we have the total number of exemptions on the original return, comparing that to the total number of exemptions on the corrected return. The difference is, of course, 1. We have the dollar valuation being applied, $7,400 of exemption deduction compared to $11,100 of exemption deduction. And the difference is the exemption awarded for Laura. Then we want to list all dependents that were claimed on the amended return if the number of dependents on the amended return is more than the number of dependents on the original return. So we've listed both dependents, one of whom is eligible for the child tax credit, that's the daughter. And then we've described the changes to the return. So that is how to correctly complete an amended return. And when you are working with tax software, do not assume that the tax software gets remotely close to this result without some labor-intensive work on you as the preparer. It will never come out with the correct result without you having done some work and thinking. Next question, our next topic of the day for the last 10 minutes of class is tax on the investment income of certain minor children. To prevent wealthy individuals from avoiding tax by turning their investment income over to their minor children, the government created the kiddie tax. And the kiddie tax is assessed on investment income that exceeds $1,900 for a minor child who was under the age of 18 on the last day of the year, or certain children age 18 on the last day of the year, and certain full-time students over age 18 and under age 24 at the end of the year. There are 2 different ways that the kiddie tax is assessed. One way is for the parent to attach Form 8814 to the parent's tax return, where the parent will then report interest and dividend income of the child on the parent's return. The other way is for the child to file his or her own return and attach Form 8615 so that the child will pay tax on his or her investment income at the parent's higher rate. So the forms are a little bit similar in that they both start with 8, and 14 is only 1 digit off of 15, but the 6 in the middle is different. So anyway, I go 15 and 14, but it's actually 8814 and 8615. Parents' election to report child's interest and dividends. So if your child has investment income from interest and dividends only, including Alaska Permanent Dividend Funds, that totals less than $9,500, the parent can elect to report the investment income of the child on the parent's return. Why would a parent want to do that? Well, there can be, it's simpler. Whacking my child's income on my return means the child doesn't have to file his or her own return. I don't have to pay a tax preparer to do that for me, or I can't be bothered doing it myself, so the parent just does that. So that's one reason to do it, simplicity. But if you want to make the election to do that, you have to have a child who has only income from interest or dividends, including capital gain distributions shown on a Form 1099 DIV or Alaska Permanent Fund dividends. That's the only kind of income the child can have. The income of the child cannot be in the form of stock sales or sale of any other property, wages or earnings that the child had, or any other form of income that the child had that was not interest or dividends. If you want to make the election, you have to attach Form 8814. You can make the election if all of the conditions following are met. Firstly, that the child was under age 19 or under age 24 and a full-time student on the last day of the year. That the child is required to file a return if you do not make the election and include the child's income on your return. That the child had income only from interest or dividends. That the gross income of the child is less than $9,500. The child paid no estimated tax under his or her Social Security number. No federal income tax was withheld from your child's interest or dividend income under the backup withholding rules. You are the parent whose return must be used when applying the special tax rules for children, and the child does not file a joint return. So why should I file 8814? I told you about the simplicity. The advantages include that no separate return needs to be filed for the child. The parent's investment income is increased, which may allow a larger investment interest deduction. If the parent has, investment interest expense they're not otherwise able to claim, this would allow them to use that interest to offset the income of the child. The ceiling for charitable contributions is increased. If the parent happens to have given away more than half their income during the year to a qualified charity, that would allow them to claim more of a deduction there. And the first $1,900 of income is not included in the parent's taxable income. So if the child has investment income of less than $1,900, there's actually no tax consequence to the parent, really. It doesn't get included in their income. They just add some extra tax on the tax line. But what are some disadvantages? Well, you will increase your AGI with the following possible negative results. Deductions subject to AGI may be phased out. EIC, child and dependent care credit, the child tax credits, could be reduced. State taxes may be affected for states that base their tax rate on your federal AGI. Now, we literally had a client in our office a few years ago. The firm that they had used in the past to prepare their tax returns had included the child's investment income on the parent's return, probably because it seemed like a simple enough thing to do. But this particular firm did not stop to think about the earned income credit. And the child's investment income being thrown on the parent's return put the unearned income of the parent, or the investment income of the parent, over the threshold amount, which is around $3,600. And because of that, the parent lost out on the earned income credit, didn't get it. And it happened to be that our staff member observed that this had happened, mainly because we were giving the parent the earned income credit in the current year. Why is this year showing a big refund from EIC and last year's didn't? So looked at it and was like, holy cow. So we went back and amended those earlier year returns. The children filed their own tax returns, reported their own investment income, and then parents were able to recover that EIC that had just somehow poof disappeared. And we were talking about several $1,000s between multiple years that had been potentially lost for those parents. So other disadvantages, the child's income may be taxed at a higher rate than it would on their own tax return. Or the parents might pay more tax on the child's income on their return than the child would pay on his or her own return. The child may miss out on the following deductions: a higher standard deduction for the blind, if they're eligible for that; a penalty on an early withdrawal from their savings accounts, if they had that; itemized deductions, if they were able to itemize. So here's an illustration of how the tax is included on the parent's return, and the income can be included on the parent's return if you attach Form 8814. J.R. Ewing is reporting $50,000 of wage income. He is also electing to report interest income of $4,500 and ordinary dividend income of $1,000 earned by his dependent son, John. Complete Form 8814 and Form 1040 as shown here. So we're showing the amount of interest income that the dependent John had, $4,500, and the amount of dividend income he had was $1,000. We add those two numbers together and we can show that his investment income is $5,500, and the first piece of math on the form is to enter a number called the base amount, $1,900. $1,900 is important, and it's comprised of two numbers. The first number, $950, is the child's standard deduction. The first $950 of income that the child has is not taxed at all. Anything above that is taxed, but the first $950 above that amount is taxed at the child's lowest rate of 10%. So if the child's investment income is more than $950, which is their filing requirement, but less than $1,900, which is the point where they move into a higher bracket, then filling out 8814 is kind of a no-brainer, because you throw the income on, you only pay a tax of 10% on the difference between $950 and $1,900. But if the income goes above $1,900 of the child, then you're going to have to make an addition to the parent's income. And in this case, $5,500 exceeds $1,900 by $3,600. This $3,600 needs to carry to the parent's return. My PDF did something weird here, kind of went distorted, but this is a cutout of line 21 of Form 1040. And on line 21 of Form 1040, we're going to enter John Ewing's return. We're going to enter $3,600 of income that he has received for his son, John. So this $3,600 up here on the form carries to the 1040 of the parent and is entered here. But we still have this other $1,900 of income. What happens with it? Only $3,600 of the $5,500 was thrown into the parent's income on line 21. Now we have to deal with the rest of the money. And the rest of the money is $1,900, and we take that $1,900 and we subtract out or show $950. The $950 is the child standard deduction. He doesn't pay any tax on that at all. And the other $950 that makes $1,900 is taxed at the child's rate of 10%, and 10% of $950 is $95. And what happens with the $95? Well, that is added to the parent's tax. So that amount is added to the tax calculated for line 44. So remember we said at the very start of the class that you figure the tax to enter on line 44 by going to the tax tables. And you pull that number from the tax tables. And the number showing on the tax tables for John Ewing, or for J.R. Ewing rather, is not $40,400. It would be $40,400 minus 95. So if that's an exercise you want to do, you go to the tax tables, you look up the tax for this filer based on his income, and you get $40,400 minus 95. And so, of course, whatever number we show on the table, we add in the $95, and that's the amount of tax that John owes. So that's how 8814 works. 8615 works a little bit differently. In this case, the child is filing his or her own return, and if that return shows more than $1,900 of investment income, then the child has to pay tax at the parent's higher rate. Now, I don't have an illustration of 8615 filled out. I do have a copy of the form, and you will see that the form is saying how much investment income does the child have, what is the tentative tax owed on that income based on the parent's tax rate. And in order to figure that out, you have to figure out how much tax rate that the parent is paying. And it's typically not too hard. You look at the parent's tax return and figure it out. But there are some special rules that apply when you have a child who has two parents who are not filing a joint return. And this table here tells you which parent's return to use.
Password number 3 is waxwing. W-A-X-W-I-N-G.
So looking at the filing status of the parents, if you are filling out Form 8615 and you were trying to establish which parent's income to use when filling out the child's 8615 form, the first thing to look at is the filing status of the parents. And if the parents are married and live together and they file a joint return, then you will use that joint return. If the parents are married and live together and file separately, then you will use the tax return of the parent who has the higher income. Parents are married and do not live together, the custodial parent is married filing separate, then you will use the parent with the greater taxable income. But if the custodial parent is head of household, you will use the parent with custody for more than half of the year. Parents are divorced, the custodial parent has not remarried, you will use the tax return of the parent with custody for more than half the year. Custodial parent has remarried and the custodial and step-parent file a joint return, you will use the custodial parent's joint return. When the parent has remarried and the custodial parent and step-parent live together and file separately, then you will use the parent or step-parent with the greater taxable income. If the custodial parent has remarried but does not live together with the step-parent, then you will go back up to these rules for parents who are married and not living together. If the parents never married but lived together all year, you'll use the parent with the higher income. If the parents never married but did not live together all year, you will use the tax return of the parent who had custody for more than half the year. And if you're dealing with a widowed parent who has remarried, you will use the rules for custodial parents. So that's how the table works, and you apply that table when you're completing Form 8615.
And the last item of session 22 is the homework assignment. We are going to have you prepare another amended return for this homework assignment. This time we have a character named Dr. Hewer. He forgot to include consulting income for work he performed from home on his original 2011 return. He received a Form 1099 miscellaneous reporting income of $2,000, Box 2 non-employee compensation. Dr. Hewer doesn't have any expenses to claim against it. He did realize also that he did not claim his niece Sally Hewer as a dependent. Sally lived with him all year. A copy of Dr. Hewer's original tax return is included for reference while preparing his return. Prepare a corrected Form 1040 return and then Form 1040X. So that concludes session 22 of the basic tax course. I will see you next time as we begin session 23. Thank you and bye-bye.